Good morning, Europe. Good afternoon, Asia. Good evening, the Pacific Rim, in especially Australia and New Zealand. It's a huge pleasure for having you on board here for our first time, I have to say, global conference and global roundtable, which is a combination of 3 time zones and a collection of several roundtable and speeches around the topic sustainability, how we make the markets better with the help of capital markets and financial markets. I have to say a great thank to our partners here, long-term partners, the Malecki Group, OMFIF, and not to forget Union Investment, our asset management company, Morningstar, and our delighted partner, Deloitte. I'm very happy to say that we have everyone on board and nearly 50 people speaking in these 10-hour sessions throughout all these 3 major time zones. Yes, sustainability is our new normal, and thank God, if there is one thing to mention which is positive on the pandemic, it is definitely the boost towards to 2050, a carbon neutral environment on Mother Earth. I can just say, personally, I'm a father, a family father of 3 beautiful and strong young men, and I hope they have a future and a tomorrow and a sustainable tomorrow. Having said that, I like to pass on to my partner, David Marsh, who is also a long-term friend. David Marsh is running as a chairman, OMFIF, a non-profit organization and platform which brings capital markets members from all sides and public servants together. And I've never seen a person who is so talented, gaining stuff, and also with all the topics he has risen throughout the 11 years of existence of OMFIF. David, the floor is yours. Please take over. Thank you very much. And have a good start, all of you, and I hope you can stay on as long as the times allows us. Thank you very much.
So thank you, Frank, and thank you for your warm words. I'll be handing the ball back to you in a moment for you to introduce the governor. I've been also very pleased about this fantastic collaboration that we have with DZ Bank now going back, as you say, 11 years, Frank, and without the help that we've had and the advice and support from Frankfurt, we wouldn't have built OMFIF into what we have now. So a warm vote of thanks to you. As you say, it's a very ambitious undertaking that we have today. And we're trying to bring together the policy aspects and the capital market aspects, linking these, as you say, more than 50, nearly 50 people from around the world in the 3 major time zones. And to paraphrase the former German economics minister, a legendary figure in the 1960s and the 1970s, Karl Schiller, capital markets may not be everything, but without capital markets, everything is nothing. Capital markets are extremely important in this overall dimension, where we're trying to bring together the policy environment with the world of business and finance. And as you rightly say, Frank, one of the rather unexpected side effects of the pandemic has been to alert people to the risks that we have for the planet of climate change, global warming, other risks that are coming upon us. Many people thought it would be the opposite. In fact, that's not the case. The sensitivity of people during the crisis for these issues has been heightened somewhat. People are not just thinking about their day-to-day existence. They are thinking about the world of tomorrow. And that is what we're trying to do in these 10 hours in front of us. It's very important that we pass the baton on piece by piece. We start off with Asia. We have some wonderful speakers from China, from Southeast Asia, talking about China's lead in this undertaking, but also about the role that Southeast Asia and all the institutions, all the organizations, all the financial markets in Asia play in all this. Asia is something of a beacon, I believe, for the rest of the world. We're bringing in Europe. This is where OMFIF is based. We have our headquarters in London. Britain may have left the European Union, at least for a few years, but we are very much part of Europe. And so with our sustainability policy initiative, this is the institute that we've set up in the last year, we need to play a real role here in Europe. I'm very pleased that We managed together to get our friends from the European Commission, from the European Investment Bank, from the Council of Europe, and of course the KfW, the major German agency that is ever since the post-war period has been playing a big role in sustainable development financing, not just for Germany, but for the whole of Europe. The KfW does have an international footprint, also extending into areas like Africa. And then perhaps the most important aspect of what we're trying to do today is the American dimension. 2020 was not all bad. It did see an election in America, which I think many people would welcome, that there has been a change of tone, a change of approach in America, a more polite tone, a more conciliatory tone, a more multilateral tone. The policies vis-a-vis China may not have changed that much, but the tone in which these policies are being articulated and implemented has changed enormously. And the same goes for sustainability. The fact that on day one, Joe Biden on the 20th of January determined to bring the Americans back into the Paris agreements, that has been a significant landmark for the world and something that we'll be talking about, I know, in the forthcoming 10 hours. And so harmonizing the regulatory approach between Europe, Asia, and America with this new spirit we have now in the White House is of great importance. It could well be that the Americans who we have on our panel today will be telling us that they're going to pose some real competitive threats to Europe. I firmly believe, and we'll hear this afternoon, I hope, that the Americans are going to go onto the front foot in the regulatory agenda and drive the agenda forward. And it could be that in a couple of years' time, the Americans may be ahead of Europe, having been lagging here because of the fact that we've had Mr. Trump in the White House. I think that's good. I think competition improves the whole area for doing business. And I do, therefore, welcome very much our American friends today, particularly Sarah Bloom Ruskin, who's played a major role in Washington in the past, both at the Federal Reserve and also at the Department of Treasury. She'll be speaking to us this afternoon. We also have Ann Simpson from the Californian fund, CalPERS, and we have Flora Chow from IFC, along with many others. I just mentioned those because that happens to be my panel, and therefore I have a vested interest in making sure that lots of people listen to this. So building the links between Asia, Europe, and America, that is really the leitmotif. That is what we're trying to do today. And thank you, Frank, and all our colleagues and friends so far. We mustn't sing too many praises before it's all over. It's looking pretty good so far. All the technicalities seem to be working well. We've got Governor Diokno ready to go. I'm going to hand back to you now, Frank, to do the introductions to our friend from the Philippines. Thank you all for being here. I wish you well. I hope you have a good day. And then let's build on the achievements, those that we managed to accomplish today. Let's build on that for our future weeks, months, and years. Back to you, Frank, and please do have a very good day, everybody.
Thanks for the pre-summary, David. That was very well done, as usual. Beside my professional role as heading the senior executive banking at DZ Bank and holding the contracts to all public and government entities, capital market related throughout the world, I'm honored more than 1.5 years ago became a member of the Sustainable Finance Advisory Council of the German government, and we just released our report last week. You will also hear our president of that council and the chair later on, Carsten Löffler, who will refer to the end of the European bloc, more about what Germany is thinking. But the role of capital markets in implementing the global sustainable agendas, we now start with our first honorable speaker. It's Governor Diokno. Benjamin, thank you very much for making it up that late in the afternoon. And we know in your position you have served for so long, and you are, may I say so, like in German and in English translated, you are an old, smart, clever fox throughout all these years what you have served. And you have served not just at the central bank, you have served in many public offices as a consultant to various multinational agencies. And obviously you had a tremendous career in academia. but you are based on the Philippines. You are sitting in your office in Manila, and your country, your rim, is facing the challenges of the global climate change in particular. And we are very eager to learn how you and your colleagues are helping to serve that. I guess you work very close together with another famous institution, which is based on the island, the ADB, and many of your Asian and Pacific colleagues. So please let us know, how do you shoulder all of these challenges, and what is your message to all of us? Benjamin, please.
Thank you, Frank. Distinguished guests, esteemed officials of the UMFIP and DZ Bank, participants, ladies and gentlemen, a pleasant morning, afternoon, and evening to all. As I understand, this event spans over different time zones. First, I would like to thank the organizers from UMFIP and DZ Bank for inviting me to join this virtual sustainability symposium. The theme, the role of capital markets in championing the sustainability agenda, is timely and relevant as the world continues to wage the battle against the COVID-19 pandemic. On top of the economic costs due to the pandemic, the risk emanating from the unchecked climate change puts a tragic toll on the environment. There are also social inequalities and injustices that give rise to poverty and starvation in some parts of the world. So what is the role of capital markets amidst this emergency situation we are in? When we talk about capital markets, the first thing that comes to mind is financial intermediation. The capital market works as a link between those that have unused surplus savings and end users who are in search of funds to support their operations. While a capital market enables the channeling of funds among different parties for varying reasons, it is important to emphasize that those funds are directed to critical and responsible use. The phrase critical and responsible use pertains to utilizing those funds for a right purpose. As such, the driving force behind financing through the capital market is not only directed towards economic growth and financial stability, but more so on incorporating sustainability goals. At this point, let us look more closely at sustainability principles and goals. Why are they relevant, and is there really a compelling reason to leverage the capital markets towards meeting a sustainability agenda? I'm very sure that all of us will agree that the answer is yes. Indeed, capital markets have the power to mobilize capital to fund innovation and ideas that would help create a more sustainable environment. According to the Bank for International Settlements data, as of end January 2021, the amount of outstanding sustainable bonds was about 1.5 trillion US dollars, of which 75% are green, 13% are social, and 12% are sustainability labeled bonds. These numbers are noticeably higher than the amount outstanding a year ago, which totals 915 billion US dollars. Yet the size of the sustainability bond market still proves to be small relative to conventional comparators, which has a total outstanding size of 127.6 trillion US dollars. Meanwhile, in terms of issuers of sustainability bonds, financials account for 41%, followed by non-financial corporates with 29%, and the official sector, including supranationals, with 21% share. This profile suggests that the sustainability debt market is still dominated by non-sovereign government institutions. Thus, the challenge now is how to further promote wider participation from various sectors of the economy to facilitate the transition to a sustainable environment. As a response to this challenge, A great deal of policy and regulatory initiatives on a national, regional, and global scale are already underway. These measures have been adopted to promote sustainability awareness across the different sectors of the economy. OMFIP, under its Sustainable Policy Institute, has been tracking these developments. These initiatives show the growing recognition of sustainability principles in one's strategy and processes. The objective of these initiatives is to strengthen resiliency against any kind of risk, be it financial or non-financial, and contribute to the long-term well-being of the economy. For instance, increased participation in the central banks and supervisors network for greening the financial system, or NGFS, which has 87 members from an original set of only 8 in December 2017, and the United Nations Principles for Responsible Investment, which grew to more than 3,100 from 86 investors since 2006, confirm the heightened interest among key players in the capital market in transforming the ideals of sustainability principles into action. In the case of the Bangko Sentral ng Pilipinas, or the Central Bank of the Philippines, it formally embraced sustainable central banking in 2020 as one of its strategic objectives. Through its sustainable finance framework, the BSP commits to embed sustainability principles in key areas of the bank's operations to the greatest extent possible. Further, the BSP issued guidelines on sustainable finance framework requiring all banks and financial institutions under its jurisdiction to incorporate ESG and sustainability principles into their corporate strategy, risk management, and bank operations framework. In 2020, the BSP also joined the NGFS community. BSP's membership strengthens its collaboration with counterpart regulators in building awareness and contributing to the effective management and mitigation of the impact of climate and other environment-related risks in the financial sector. The Philippine government and the private sector, through financial institutions, are also working diligently to contribute to promote the sustainability agenda of the country through several initiatives. First, the Philippine government has adopted the Green Public-Private Partnership Project Initiative. Second, the National Economic Development Authority, the Philippines Planning Agency, developed the Philippine Action and Plan for Sustainable Consumption and Production, or PAP4SCP, with the support of the Asian Development Bank. The PAP4SCP serves as a guiding framework to influence and steer sustainable practices and behavior across sectors and levels of government by implementing policy reforms and actions over the short, medium, and long term. To address concerns over climate change, the Philippine government introduced in 2019 an interagency Green Task Force led by the Department of Finance to facilitate the harmonization of climate policies across government agencies. This task force is working with the Securities and Exchange Commission and the Bangko Sentral ng Pilipinas in creating a green taxonomy that outlines what projects are considered green and ensure that these definitions are amenable to all government agencies. Third, on the commercial front, the Securities and Exchange Commission, the Philippines government regulatory agency charged with the supervision of capital market participants, has been leading the country's work in green finance at the Asian Capital Markets Forum, or ACMF, as the co-chair to the Forum Sustainable Finance Working Group. In fact, the ASEAN Capital Market Forum has been central to the development of the ASEAN Green Bond, social and sustainability standards, as well as its roadmap. Likewise, this institution is also involved in the development of the sustainable reporting guidelines for publicly listed companies, aligned with its policy of greening the stock exchange. There are also green banking programs initiated by commercial banks that focus on the development, financing of sustainable projects of targeted sectors of the economy. These are done through lending and continuous issuances of ESG-themed debt.
Yeah, ladies and gentlemen, sorry, I switched to English. We have no tone from Benjamin. Benjamin, if you can hear me, there is a very bad line at the moment. We can't understand. Oh, no.
To leave a legacy for future generations. Gro Harlem Brundtland defined sustainable development as, and I quote, the development that meets the need of the present without compromising the ability of future generations to meet their own needs. To make this happen, the role of capital markets is central in providing the necessary supply of risk capital that could be channeled to users of funds for sustainable financing. Thank you.
Benjamin, Governor Jogno, thank you very much. We had 10 seconds where we had a bad line, but most of the message was clearly understood. I appreciate what you said, and I think to point out one fact that the public sector have just an issuance volume on the global SDG pot of 21%. I can't be more than agree with you. This is way too little, because the public side should definitely guide by positive and best example throughout the world, and trying to make markets more encouraging, as well as corporates, to issue way more volume for all the good investors, in particular pension funds, dedicated funds for SDG-related investments, whether it is green, social, gender, or any of the other 17 SDG gold topics. Yeah, thank you very much. I hope you will have a lot of success. And if Germany, the Sustainable Council, or anyone at the Ipsf family can be of help to assist or to be a partner, just to exchange or to advise, you are more than welcome. And we're looking forward to help you there in discussion and hopefully in action.
Thank you very much, Frank.
Thanks, Benjamin. And if travel allows us, I hopefully can go throughout the region with Adam Cotter. Adam Cotter formerly worked for David Marsh at Ipsf. He set up the Ipsf operation in Asia Pacific, and I'm very honored that with the agreement of David Marsh and John Orchard, the CEO of Ipsf, who is also a long-term friend, I was able to hire him into the DZ Bank family. And Adam Cotter is responsible for all the activities around senior executive banking in the Asia Pacific Rim. He is not in this room, but after a short break of roughly 1 minute, he will take over to moderate the first senior panel. I'm very delighted to see the presence here of long-term partners like the IFC, our bridge builder, Niall Bohan, Deputy Director General at the EU, Henry Chan, who is from our BIA Union Investment out of Hong Kong, Hong Patterson from the Green Climate Fund out of Incheon, and not finally to forget, Craig Wise. Craig is rather late in New Zealand now, I think after 8 o'clock in the evening. He's the Chief Executive of the New Zealand Investment and Financing Institute in Wellington. Have met him also just a year ago. Unfortunately, I couldn't travel in between as many of us. And not to forgotten our one of our most important people we have today in our 10 hours, my former colleague, Dr. Ma Jun, the chairman of the Green Finance Committee of the China Society for Finance and Banking. He's the president of the Beijing Institute for Finance and Sustainability and sits at the moment in Hong Kong. Ma Jun, it's a great honor to have you here in person as usual, and thank you very much. Ni hao, and have a good start with the panel, Adam. Thank you.
Well, thank you very much, Governor Diokno, Frank, and David for kicking off this marathon conference in such fine form. My name is Adam Cotter and from DZ Bank here in Singapore, and I'll be taking you through the next 4 hours or so until the end of what we're calling the Asia segment. However, it is really in name only, as the whole idea of this conference is to be global and to share ideas and best practice from all parts of the world. Now, of course, 2021 certainly does feel like it's a key year to demonstrate the transformative potential of climate finance, especially as we race to COP26, with COP26 being anticipated as probably arguably the most significant climate event since the 2015 Paris Agreement. From a regional perspective here in Asia Pacific, we of course can't escape the fact that Asia Pacific accounts for 60% of the world's population and more than 50% of the world's CO2 emissions. It too has suffered from a reputation from being regarded as somewhat behind the curve on sustainability. But with China, Hong Kong, Japan, Singapore, New Zealand, Australia, and South Africa, along with others, now having their carbon neutral targets or even a strong statement of intent, change seems to be coming. Now, we have a great diversity of institutions and speakers in the next panel to talk about the critically important work of mobilizing capital markets to realize the global sustainability agendas. And it'll be a great opportunity for you, the attendees, to get to know the institutions the speakers represent, as they are all very different in how they operate and how they view the world and challenges ahead. So I'd like to kick off in earnest and start the next segment by inviting Dr. Ma Jun, Chairman of the Green Finance Committee of China Society for Finance and Banking and President for the Beijing Institute of Finance and Sustainability, to share with us an update on green finance development in China, including the new roadmap to support carbon neutrality. Over to you, Dr. Ma.
Thank you very much, Adam. Can you hear me okay? Great. Thanks again, and thanks to DZ Bank for inviting me to join this very important discussion. I will give some introduction to China's green finance developments in the past few years and discuss specifically what the green financial system should further do in light of the carbon neutrality target that our president has announced just a few months ago. And then a few words on international initiatives, which China has actively participated in. Now, within China, in the past 6-7 years, we have built what we call a framework of green financial system, including at least 4 key elements. One is taxonomy. Second is disclosure requirement. The third one is incentives. And fourth one is product suites. On the taxonomy side, we have now at least 3 sets of taxonomies, one for green lending, one for green bonds, one for green projects, and the green bond taxonomy is now being revised with the goal of being better in line with the carbon neutrality target. For example, the new version of the green bond catalog has removed the clean coal technology category from the old catalog, so that even though some of the projects which could reduce air pollution, but they would increase carbon emission, these projects are no longer included in the new version of the green bond catalog. And I think the other taxonomies will also be revised accordingly to be more consistent with the climate objective. The second aspect is a disclosure requirement. We have a few efforts from different ministries, including from the Ministry of Environment, which put in place a mandatory requirement for all major polluters, which are defined by them because their pollution or emissions are exceeding certain level. And these companies were asked to report the pollutants and carbon emissions on a mandatory basis starting from 2017. And gradually we moved towards a semi-compulsory scheme for listed companies. And China has a goal of introducing mandatory disclosure requirements for listed companies, bond issuers, and for financial institutions over time. For example, in Shenzhen, which is a special economic zone, they published their own requirement of asking financial firms to disclose environmental climate information on a mandatory basis in the coming 2 to 3 years, depending on the size of the financial firms. And in the future, I think we should further improve disclosure requirements, especially in light of the climate agenda. So we're now pushing for the financial institutions to begin to calculate carbon footprint of their loans, not just carbon footprint of the building. They need to calculate the projects supported by loans and how much carbon has been emitted and whether the carbon emission divided by the amount of loan, which is what we call carbon footprint of the loans, are being reduced. So these are the new areas of work for disclosure. In terms of incentives, we had quite a few. At the central bank level, we had a re-lending facility which offers cheap financing through commercial banks to green projects. At the local level, some localities offered subsidies for interest payments and guarantees for green projects. But now, with the new carbon neutrality target, we will revamp these incentive systems to make them much stronger for low carbon projects. For example, I was making the recommendation early this year to the central bank that we should expand the re-lending facility to a much larger scale and the target specifically for low carbon projects. And we should consider reducing risk weights for green assets and increasing risk weights for brown assets, including high carbon assets. We can keep the overall risk weights unchanged for the banking system. But such differentiated risk weights treatment, I think, will be necessary to steer the reorientation of bank loans and investments towards greener portfolio. The fourth element of the green financial system is what we call the suite of products. We so far have the largest green lending market in the world, which amount to at least 12 trillion RMB in terms of outstanding amount of loans from 21 large banks. And the overall outstanding loans may be 13, 14 trillion if you count the smaller banks. And we have second largest green bond market. The issuance in the last 5 years was 1.3 trillion RMB. And we have a lot of room to further improve, scale up the size of the green finance markets and innovate on many, many new products. For example, we are now discussing transition bonds and zero carbon bonds. And we're discussing options to develop carbon footprint related loans and bonds. And we have developed some, but we'll develop further the insurance products to cover solar, wind, and green building, which are largely for energy efficiency purposes. So these are just a few examples of the potential product innovation, but there are many, many of these. They're popping up like a mushroom. Now, moving to a few international initiatives that China has participated actively play a role. We have the G20 Green Finance Study Group, which was initiated by China in 2016 when China was the presidency of G20. And that group lasted for 3 years. In year 1, 2016, the group essentially facilitated a global consensus on scaling up green finance within the G20 platform. And the second year, we promoted this idea of conducting environmental climate risk analysis by financial firms, which were then taken up by NGFS in a more aggressive way. And the third year, in 2018, the study group initiated the idea of developing ABS for green assets and developing green PE and VC and applying fintech to sustainable finance. I think many of these ideas are now becoming more mainstream in the financial industry. And interestingly, after 2 years of silence, the study group is now re-established by the presidency of G20 this year, that's Italy. And the central banks and governors and the Minister of Finance of the G20 just decided back a week ago that it would relaunch the G20 Sustainable Finance Study Group. And I had the honor to be reappointed as the co-chair representing China. And this year, the other co-chair is the US. The US Treasury will be co-chairing with Chinese PBOC for G20 Sustainable Finance Study Group, which we hope will last for not just 1 year, but for many, many years to come. And the second initiative internationally, very important one, is NGFS, which was launched by 8 country central banks, including PBOC in 2017, and now has expanded to more than 80 members. US Treasury just joined recently. So it includes now all major countries, central banks, and supervisors in becoming a very important platform for policy discussion and policy coordination in the financial space for green and sustainable finance. And one piece of work which I led under the NGFS was the publication of the environmental risk analysis methodology case studies. It was a 600-page document published last year in September on the NGFS website. It included more than 30 organizations' methodology on how to quantify the financial risks, namely credit risk or market risks, arising from financial firms' exposure to environment and climate risks. I think these methodologies need to be promoted globally among all kinds of financial institutions for them to guard against these potential risks and facilitate the transition of their portfolio away from brown and towards green. The third international initiative that I'd like to mention briefly is IPSF, International Platform for Sustainable Finance. It was set up a little more than a year ago by EU, China, and a dozen other countries. And under the IPSF, China and the EU have co-chaired a working group on sustainable finance taxonomy, which is now working on a common ground taxonomy that's based on the Chinese taxonomy and based on the European taxonomy. And we're hoping that in the second half of this year, this group will come up with this document called Common Ground Taxonomy, which could be used by any users essentially globally on a voluntary basis. And for example, a Chinese bank can use this Common Ground Taxonomy, which is recognized both in China and Europe, to issue green bonds in Europe. And a European company can issue green bonds using that taxonomy in China without the need for double verification. And it certainly will help reduce transaction costs, increasing transparency. And the final point I'd like to make is the Green Investment Principles for the Belt and Road, which was launched by China Green Finance Committee that I chair and the City of London back a little more than 2 years ago. It was designed to promote green investment by global institutional investors in the emerging markets. And this set of principles are now being endorsed by 38 large global institutions. And these institutions collectively manage more than $40 trillion US. So by signing up to the GIP, they are now committed to enhance the greenness of their operation and investments in the emerging markets, especially in the infrastructure space, and reducing the exposure to brown operation. And we have a lot more details. If we have time, I can share with you. But given the time limitation, Adam, back to you.
Thank you very much, Dr. Ma. It's very interesting to hear the number of different international initiatives going on there. Of course, domestically in China, China's annual Congress kicks off tomorrow, and this year sees the start of the 14th five-year plan. There are a lot of expectations that China will align more strongly its domestic policies with the international pledges on climate change. There has, of course, been quite a long-term appreciation from the central government in Beijing of the value that ESG policies can bring. Do you think there's now a markedly growing appreciation among Chinese companies as well as local governments in China?
Yes, with the carbon neutrality pledge by our president in September last year, now every province and some cities and even counties are beginning to plan the carbon neutrality roadmap. For example, I myself was leading a team to help Chongqing municipality, helping Nanping city in Fujian, helping Kaihua County in Zhejiang to develop carbon neutrality plan and the green finance roadmap to support the carbon neutrality objective. And many sectors, including the ministries in charge of these sectors, are now planning carbon neutrality roadmap for energy, for transportation, for building, and so on. So I think the whole country is now moving very quickly towards a roadmap, and we're looking forward to implementation very soon.
Excellent. Now, I know you have to run off for a G20 meeting, but I can't let you leave without asking whether you believe the US can catch up with China and Europe on climate leadership.
I think the US is actually very active, just given the limited contacts I had in the past couple of months with them in rejoining the global discussion on green and sustainable finance. And they've been proposing good ideas on improving disclosure and enhancing capacity for climate-related risk management. So I think all these are very much welcomed.
Excellent. Many thanks, Dr. Ma. Now I want to move on to the other panel speakers, and thank you to all of you for waiting patiently there. And Dr. Ma, if you're able to, please remain an active part of the discussions, but understand you have other commitments as well. So also joining us here on the panel are Martin Bill, Head of Funding Asia Pacific at the IFC, based in Singapore, Niall Bohan, Director of Asset and Financial Risk Management, the Directorate General for the EU Budget. Joining us from Brussels, we have Henry Chan, Chief Investment Officer of Equities at BEA Union Investment in Hong Kong, Hong Patterson, Chief Financial Officer of the Green Climate Fund, joining us from Incheon in Korea, and Craig Weiss, Chief Executive New Zealand Green Investment Finance, joining us from his evening in Wellington in New Zealand. Apologies in advance, but I'll have to move swiftly on, and perhaps I could start with Hong. Straight into the questions, but Joe Biden moved to reinstate the US to the Paris Climate Agreement just hours after being sworn in as president. Now, with all eyes on the US for global climate change leadership, how important is this for institutions like the GCF and emerging markets across the globe?
Thank you, Adam, and thanks for inviting me to this panel. Yeah, so it was great news to hear when Biden came in, and a little bit of a plug for GCF. John Kerry was just with us, and there's a great article in the Rolling Stone in which he talks about climate change and the criticality of it, and he does reference the Green Climate Fund. Just, I guess, maybe a little bit of background. So the Green Climate Fund was founded off the back of the Paris Agreement. It is the largest climate-focused fund, but the goal of the GCF is really to support developing nations meet their requirement under the Paris Agreement, which is to limit, ideally, the change in temperature to below 1.5 degrees. There's question on whether we actually have, have irreversible damage beyond that, but at least to 2 degrees. So in terms of what we do, and this is really important, I guess, with the U.S. coming in, it just brings that that phrase, a rising tide lifts all boats, from John F. Kennedy. I think that's really how I look at the U.S. coming in. It really brings that urgency to the forefront, and all eyes will be on the U.S. in terms of how they move, and I think that will really influence the rest of the world as well. But in terms of the Green Climate Fund, what we do is, we look at it across a four-pronged approach in terms of transforming planning and transformational planning and programming, and that really speaks to looking at the strategies and policymaking and trying to create an integrated approach to that across countries. Catalyzing climate innovation and investing in new technologies, business models, and really taking that that first level risk that we do tend to see where private side do hesitate. Third prong is de-risking investments to mobilize finance at scale, and that talks directly about that, about sequencing and the kind of risks that we can take that most private side can't take. I keep talking about public and private because that is going to be really important in terms of the amount of money that is required to really turn this problem around. And I guess is the last prong is really around mainstreaming climate risks and opportunities into investment decision making and aligning finance with sustainable development. And really that talks about promoting methodologies, standards, practices, and really moving to that new norm. But from a GCF perspective, what we do see is that public sector money is quite scarce, and we look at opportunities across both mitigation and adaptation, and so that public money is quite scarce as they think about what they have to do for their constituents, the strains and stresses, and so that private side and attracting that private sector money to come in is really important. The countries, they had committed about $100 billion a year at the Paris Agreement for all the nations, and that's it's nowhere close, right? And so I do think that it's critical for private side to come in and think about how this will change the way they look at development in market recovery. And it is something that GCF plays an important role in, and I mentioned in terms of sequencing, taking that first risk, whether that's sovereign risk, whether that's technology risk, that's something that we can take on and partner with with the private side to develop. We are, at the end of the day, a partnership model. So.
Thank you very much, Holland. I think those points about private sector involvement and de-risking are very important, and it takes me nicely on to who I'd like to go to next, Martin from the IFC. Now, the IFC, of course, has some ambitious commitments to grow its climate-related investments and is also a frequent issuer of social bonds in public and private markets. Perhaps you could share some of your observations on the current market dynamics for sustainable finance and what's going on, particularly here in Asia.
Thanks, Adam. Thanks for having me on the panel as well. So IFC, for those of you who are perhaps less familiar, is one of the agencies of the World Bank Group. We do focus on lending money and investing in equity projects in emerging markets globally. We have been providing a climate smart project financing for quite some time, and since 2005, we've actually provided globally about $28 billion equivalent of lending in that space, as well as we mobilized additional $22 billion. And in Asia in particular, for the past 5 years, we've invested or lent in 5.4 billion US dollars and mobilized another 3 billion. So we are becoming and have been quite active in Asia, looking at this market as very perspective, and there's certainly on the back of what's been said so far, a lot to do here in terms of climate mitigation and initiatives along these lines. In terms of our targets, the aim is to have at least 30% of our commitments channeled towards climate-related type of projects. We're planning on ramping it up to 35 going forward, but de facto, all of our projects meet sustainability criteria in a broader shape or form as well. So as such, our evaluation process as far as projects that get accepted is quite thorough. And as such, we as an institution have been issuing green and social bonds. So far, it's been about 20% of our program, which annually is about 17 billion. So for our credit, we've been providing these bonds, starting with actually green bond space, where in 2013 we issued the first $1 billion green bond, which was the biggest at that point, and we like to believe that contributed to the growth of the green bond space, providing liquidity to investors who were very much asking for it. These days, the landscape is much different, and we see actually demand for thematic bonds in many more shapes. And on the back of the COVID-19 development, a lot of some call it social bonds, some pandemic bonds, but regardless of the nomenclature, these were bonds issued with thinking of supporting businesses that have been affected and people ultimately affected by the pandemic itself. And on the back of that development, we've seen a huge increase in demand and awareness about ESG and thematic bonds in Asia. we have seen an increase in activity by Asian investors and across actually various countries. We issue in 25 currencies globally, and investors also do come from various jurisdictions. And as such, we can, I guess, fairly say that there is price advantage that can be achieved through issuing thematic bonds these days. This was our original philosophy in terms of pursuing the thematic bond agenda. I'm a strong believer in market-driven forces, and as such, we can see that we can achieve with tighter spreads advantage of 2-3 basis points for thematic bonds. And so corporates out there who would like to find financing for their projects can, I'm sure, achieve even more savings for projects that there's plenty to come on the back of zero carbon emissions declarations. Perhaps some examples of what we do, just not to take the floor for too long. We also work with our clients. I guess that's important for them to issue bonds of themes of various nature. An example in Asia would be we helped AC Energy in 2019 we invested in 75 million of their first ever listed green bond, which the proceeds were then used to fund solar and wind projects in Vietnam. So this is an example of what we do on the client side, and on our own credit side, then we can issue green bonds against these types of pipelines as well, potentially. I'll stop there. Thank you.
Thank you, Marcin. Yeah, of course, obviously, given the pandemic, there was an increase in the thematic bonds, but it does seem that climate-related and other types of green bonds are seeing somewhat of a renaissance as leaders try to formulate a green recovery. So moving on to Craig. Around the world, green investment banks like the NZGIF have been established to catalyze private investment in low emissions and sustainable projects. Whereas most economies are still thinking or on the journey of decarbonizing their energy supply, New Zealand already has a lot of large-scale renewable energy. So what are the next steps you are considering when moving beyond just building renewable energy projects?
Thanks, Adam. And thanks for asking us to join the panel as well. Yes, that's right. So our position is a little bit different to most in that we have, in a good year for our hydro, about 85% of the grid coming from renewable energy. And wind has been on the scene here for some time as well. Not so much solar, which is emerging here. So what we have done is really looked at, our national emissions profile on a sector basis, and are aligning, if you will, where those emissions are with investability in the market. And that puts you in some different places. So, transport, for example, and the built environment become much more of a feature. And for us, agriculture as well, as we are a large agricultural nation also. And, distributed energy in that mix also plays a role. And I think that's one of the things that you see emerging as you get away from just, grid scale utility renewables, is that there's a different role for a different scale of renewable energy project that becomes very important as we learn more about how, systems and networks behave when you start mixing, say, in our case, hydro, wind, and solar. It's been interesting to see what's happened in Australia, for example, with their networks and grid reliability as you do that with big solars coming online. And I think there's a lot for all of us to learn as that happens. Because I think as we electrify, we still need additional capacity. And so even for those of us who have lots of renewable energy, the journey doesn't end. And there's a lot of work that needs to go into the network and the grid and, efficiency measures, essentially. So heaps to do, even once you've got a large set of renewables giving you that power.
Thanks, Craig. I was just wondering, we may have a few attendees who aren't familiar with your organization. Maybe you want to share a bit more on your philosophy and the institution's philosophy and how you approach sustainability and climate change.
Happy to do that. So for those of you who aren't familiar with the green banking model, we are, if you will, a nationally capitalized green investment bank. So our role is twofold in the market. One, we are a direct investor off of our own balance sheet in the market. And two, we are utilizing our investments to catalyze private capital. And eventually that will help build, product supply that the market actually needs to get those who participate more in the listed space, the access they need to private, to capital from a direct investment perspective. So, generally speaking, we have, 4 very clear objectives. 1, we invest on a commercial basis. 2, everything we have to do has to have a low carbon element to it. 3, we are trying to demonstrate to the market and providing leadership to the market around what we're doing. And finally, we do have to generate a return as well. So we are for those of you who are in the impact world, we are a finance first investor because we're trying to move the market and show the investability of these things. However, we very much weigh, of course, all of these other factors in terms of us meeting our objectives.
Thank you, Craig. And now I'm going to move on to Henry. Before I do that, I just want to remind all our attendees, please do submit your questions and we can put those to the panelists later. But Henry, from an investor's perspective, what are some of the long-term trends you're seeing in Asia in terms of governance and sustainability? And are you seeing any clear distinctions between different types of asset owners?
Well, thank you, Adam, and thank you for getting me in a part of the panel. Have to say I'm feeling a little bit nervous here because the area that I'm in is probably contributing the least at the moment to sustainability. We are very much towards the bottom of the food chain, that we have people promoting a lot of green initiatives. We manage quite the conventional long-only products on equities and fixed income. And I think if I can describe the landscape here in Asia, is that there has been interest in, I would say, the first type of products that promote sustainability. Now, people see that as an investment theme alongside the healthcare, the technology. There is less of a, I would say, an environmental kind of a thinking behind that. It's basically something that is trendy, there's something that's fashionable. But the other type of products which apply more to the mainstream investment products is that more and more investors are asking about the integration of sustainability and governance consideration in the investment process. Now, that applies to a much larger pool of assets. The interest coming more from, or questions, I would say, coming on from the institutional investors like the pension funds, the university endowment, or sovereign funds. These are the institutions or clients who probably have more consideration or I would say pressure coming from integrating or asking the fund managers to have a more integrated process into the day-to-day investment. The other end of the spectrum, you have the retail investors who basically the gatekeepers, their interest is probably more on you have to reach a certain kind of a compliance level or or demonstrate that the process has certain degree of integration of these factors. Now, if you think about it, where we stand now has been a lot of, you can say, a ticking the box mentality. You have the regulatory requirement, you have certain client pressure, but I would say we are just at the start of a process, what I would call the convergence of the governance and sustainability factors into the price mechanism or the stock price valuation. Why I'm saying that is that like for us, I mean, for as an investor, we look for earnings growth in companies, and we look for the potential for valuation expansion. Now, the regulatory consideration of pressure are now starting to affect the earnings of companies. And so in the past, probably you invest with considering, okay, this is something not particularly good to the environment, but well, I mean, business continue to go on, I mean, on the business side. But now the regulatory side of development has started to put pressure on companies in terms of the earnings, and the consideration that I described earlier on asset owners, on fund managers, starting to affect the fund flow into the relevant stocks, and also how people look at the valuation or the risk premium towards the area. Now, we need more and more people coming on board of this consideration to create, I would say, a more positive feedback loop into that process. And I think we are just at the beginning of it, or put it in a different way. What I feel people doing day to day outside of work probably had more sustainability consideration than the investor. Maybe I consider more the environment on a day to day of recycling things. But when you go to the company assessment, I mean, I think we are still at an early stage of, I would say, the internalizing the sustainability consideration into the price mechanism. And I think if you look at the retail side, which I said earlier, it's probably paying less attention to the sustainability consideration. But I think it's changing, because I would say probably the younger generation is sort of coming into the equation. Well, hopefully they were building up the wealth sooner, that have a bigger impact on things. I mean, every day when I go home, I have a big debate with my daughter about sustainability, and obviously she had a lot of complaint of what I do, and I think these are the people who will change the world. These are the people who will come and ask for more questions about how people manage the money. I'll probably stop here, and we'll probably can expand a little bit more when other questions sort of comes along.
Right. Well, thank you, Henry. I'm glad to hear that you're seeing a demographic sort of change, and the younger generation being a bit more proactive in this space. Apologies, Niall, I had wanted to bring you into the conversation earlier, but was caught up focusing on Asia Pacific and neglected the important role that Europe is playing as a climate change leader. Of course, back in December 29, the Commission introduced the European Green Deal, which was a very ambitious policy package intended to make the EU's economy environmentally sustainable. Now, the goal, of course, is to reach climate neutrality by 2050 and to turn the transition into an economic and industrial opportunity for Europe. Do you think this is going to enforce Europe's global climate change leadership, and how is now the time for both green and social bonds?
So I think Europe, and I will speak from a purely European centric perspective here, but here it's really seen as an imperative, not a question of global competition, but we really have to take matters into our hand. And I also have children at home who lecture me on a regular basis on the importance of this. And I think that has permeated European political policy thinking really very deeply in the past few years. It is reflected in the Green Deal. It is reflected in the commitment by Europe to move to climate neutrality by 2050. And behind that is, as we have discussed here from different perspectives in Asia, there is a pipeline of economic transformation happening through renewables, through renovation, energy efficiency, circular economy. There are big policy projects being wheeled into place in Europe to try to ensure the pipeline of investable products is there. So this technological transformation takes place. So it is not just lip service. It is not here a trend. It is not a fad. It is one of the most important drivers in European policy thinking. How does that change start to take effect, or how is it being implemented? I think European governments and public finance community is really leading from the front in this field. Maybe I'll speak on just very briefly, two levels. One is the use of public finance to create incentives and help de-risk sustainable investment. I mean, we have deployed at national and at European level a huge range of financial instruments and projects to basically deal with the negative externalities associated with fossil fuel dependency. So we're trying to wean coal-dependent regions and sectors off of that and help them finance then reinvestment in alternative technology or energy sources. And we're also then trying to promote market-based solutions in their infancy through de-risking first-generation products. And that has been the case with solar in the past. We now have achieved a situation where solar can stand on its own 2 feet in Europe, etc. And public finance has been really critical in helping this to gain traction and to start to change investment flows. And the second, and probably relevant to this discussion and the audience, is the role of European governments as issuers, as in financing their own investment in infrastructure or whatever through green bond issuance. This started back in 2007 with the European Investment Bank and its climate awareness bonds. But we've seen it since 2016 and 17, Poland, now France playing a particularly strong leadership role, and this week Italy coming to market with a green bond issuance program. So we now have 10 member states of the 27 in Europe with strong green bond issuance programs, financing their own expenditure through green bond issuance. And this is really helping to deepen the market in Europe. I will conclude maybe just by talking about Europe's place then in the sort of the broader global constellation in this. You asked at the start about global leadership. I think that's not really the driver. It is nevertheless a fact that of the $1,400 billion outstanding, if we use geologic stats on sustainability, sustainable issuance, of the 1.4 trillion outstanding, and a lot of growth, particularly last year. So we're seeing an acceleration of this issuance through issuance of new green and sustainable, not just in Europe, but more globally. But Europe is accounting for about 60% of last year's issuance, 40% of global issuance in green. So I think we are there in terms of leading in terms of volume and quantities. But it's not a question of us kind of seeking to kind of occupy the top of the mountain on our own. We sincerely hope that the rest of the world will move in the same direction. It is a global imperative. It is a global challenge. And behind the financing and the issuance, we really need to see that deeper change in terms of the rewiring of our economies to be based on so that the pipeline of sustainable underlyings that will help the sustainable finance markets go from strength to strength, to see that also evolve. So I'll stop there.
Thanks, Niall. I know we do have some questions coming in from the attendees, but if I may, I'll just stick with you for a bit now, because Europe does have an important role as an issuer, as you say, but I also think Europe has a very important role as a standard setter. And to support the global sustainability transition, we need further improvements in the framework for sustainable finance. Maybe you could share a bit on what has been achieved so far in the EU and whether there are any upcoming initiatives or policy recommendations.
Happy to do that. Maybe I would start with the observation that a lot of the growth that we've had in Europe is demand pulled. It has been an organic response by markets to a real demand by civil society, and then more recently, official sector governments saying, listen, we have to get out in front of this challenge and start to change things. So it was really demand pulled. And we saw then the market standards, the ICMAs, and also the data analytic providers and the raters kind of develop in order to serve what was until recently a very nascent development. But I think that market standard, the market reaction was very far-sighted. And what we then have is this wave of member state or national or even local change, which kind of started then to percolate upwards. So we had all these national issuances. We had the EIB on its issuance program. I think we then realized Europe had a chance to leverage this and deploy this change at a continental level. And if we didn't, we would have this fragmentation and competition between these national paradigms, which would ultimately, I think, given the importance of the climate transition, start to interfere with trade flows and capital flows even within the European Union. So on both counts, we saw it as useful to bring a pan-European perspective to this and try to set some kind of policy framework, which we did through the EU Sustainable Finance Plan back in 2017. And that has then spawned, I mentioned three regulatory or policy things that we have done. And I think the parallels with Dr. Ma Yun's speech at the beginning are very striking. We did the non-corporate disclosures through the non-financial reporting, imposing requirements on corporate issuers to make available information of a non-financial nature relevant for assessment of their corporate balance sheet kind of commitment or to sustainability. The second element is the taxonomy that we are developing in Europe as classification systems so that bond issuers can determine quite mechanistically whether their investment project, where it fits in terms of climate transition support and whether it warrants and how it can be brought to market as a green bond. The third element is building on that. Later this year, the Commission will propose a green bond standard, which will clarify the obligations on an issuer, particularly private sector issuers. I think it's predicated for the private issuer, but will be developed also for sovereign. It will clarify what the obligations of the issuer are vis-a-vis to avoid greenwashing effects and to, I think, tackle that risk, which we see as a real danger for the continued strong development of the market. So that's in policy and framework development. I would also like to just mention, we ourselves are a big issuer. Now we will be issuing up to 1 trillion euros or $1.2 trillion in the period to 26. We have already launched a very big social bond program to finance temporary employment, issuing 100 billion last year and this, and which has really, I think, added huge momentum to the social bond market. We will later this year issue next generation EU green bonds, where money we are using to finance the European response to the COVID crisis through investment support. We'll try to issue about 200 billion euros of that as green bonds based on eligible underlying green expenditures. So we are using every means at our disposal to try to shift the cursor on this. I will conclude maybe just by reflecting, though, as I said, we don't want to be out in front and lonely out in front. I think we want to move this forward on a kind of global level because that's the only way we can make a difference together. In that respect, also finding global solutions and standards is going to be increasingly important as we all become more active in this space if we are to avoid this creating a new generation of technical trade barriers as we have seen in the past with products. we will need global solutions, global convergence. Therefore, the developments described by Dr. Ma Young in terms of the reactivation of the G20 momentum and the IPSFF are hugely encouraging and initiatives that Europe is very, very happy to contribute to and throw its weight behind.
Thank you very much. Niall, on that last point, echoes some questions I've been receiving about frameworks and taxonomy. So maybe I could go on to Marcin to develop some of those ideas. I mean, Marcin, do you think the achievements that Niall mentioned in Europe in terms of frameworks and taxonomy will go some way to set the global standard and reach a common language and clear definition of what is sustainable? And if I may push you to then further that and to discuss about how we may go about regulating it globally.
Yeah, good questions. And just to thank you, Neil, for taking a lot of, I guess, making some points in that space. Yes, I think EU taxonomy does set up a standard for taxonomies across the globe. Now, but there is a number of aspects that need to be considered in the context of taxonomies as well. And so I guess there is, in terms of standardization and sort of using it as a benchmark, I think there is no doubt that it's high quality. It sets up thresholds for others. There are other taxonomies out there, though, that's been set up, perhaps not as thorough, but I believe China has one for green bonds. India has one. I believe Australia is working on one. So is Singapore. Canada is working on one. So is Singapore and New Zealand. And there is difference in the way they approach the issue, I guess, and it also depends. And I guess one thing that Neil also touched on is the organic nature of how the definitions and regulation in the market sort of took off on the back of the success of the green bond market via ICMA, that now is. And it's great to see that actually transforming into a more regulatory approach by institutions, governments, supervisory bodies, etc., which is great to see. But then I think we have to remain conscious that there are different agendas out there in terms of development and in terms of path of achieving these targets, zero emissions targets between different countries and economy, or pathways, I should say, which means that, you know, what can work for one nation does not necessarily mean that it will be, you know, very adoptable and applicable in another. And an example could be Canada, which I believe is working on more of a voluntary approach. And this is more of a resource-heavy economy. So clearly their standards will have to be somewhat different, and the approach will have to be somewhat different than different types of economies. The other division line I would see is between emerging market economies and emerged economies, where, you know, ones are based more on industry and the others are perhaps more agriculturally heavy, which then creates also different balances. Speaking of Asia, if Australia thinks of adopting one, I would presume that they will be closer in thinking to Canadian approach than maybe European approach. And so the other thing is we still are developing that space, and you're likely aware that this space in terms of thematic bonds and green bonds in particular has a lot of potential to grow, and there needs to be done so much more in order to meet the targets. And it's actually super nice to hear that European Union has such huge ambitions in terms of issuing green bonds, because it's great. That's what the market needs, more supply. But then there needs to be a balance in our mind between preventing greenwashing for the markets that are more developed and standards need to be followed, and also ESG investors, and we hear that feedback more and more frequently, are asking for transparency, are asking for, you know, standardization, and they, you know, committing resources to evaluating each bond is just, you know, cumbersome, time consuming, etc. But on the other hand, you know, if the standards are too strict, it simply limits the pipeline and it increases the entry cost for the emerging market participants and private sector participants out there whom we have an exposure to. And there is a balancing act, which the discussion's been going on for quite some time. They simply need a bit more leeway in terms of or support in terms of being able to issue these you know, these types of bonds. Having said that, I actually think that this type of benchmark is a great initiative. This is something that hopefully a lot of market participants will try to mimic. By definition, issuers who would like to, financial institutions would like to issue bonds into European Union, they will be obligated to follow these standards. It's good that the corporates will be also having to make these types of disclosures. And I hope that the common group on taxonomy, the one where China is working alongside EU, and the whole initiative by IPSF is also something that would help harmonize the taxonomies amongst the country members, and more countries will join, because this will also kind of create a platform for harmonizing as much as is possible, while leaving some room for idiosyncrasies of each individual economy and country's prerogatives. I'll stop there. Thank you.
Thank you, Martin. Perhaps I could just stay with Henry on this idea or the issue of standards. I will then move on to Craig and Hong, who've been waiting patiently, because I want to get their thoughts on capacity building. We've had some questions about that. But Henry, we've heard there's, of course, an explosion of ESG issuance and also funds. ESG is, of course, becoming an inherent part of evaluating financial returns. But what are the investors' perspectives on standards? And also, do you think that investors in this region, Asia Pacific, are more focused on incentivization?
Well, I would say at the moment there's probably more sticks than carrots in terms of the ESG consideration. So you have a lot of ESG funds or people expecting ESG factors to be integrated into the process. And I guess at the moment is that there hasn't been a set of a uniform standard as to how you actually demonstrate or that you are actually integrating ESG. Some people are using just simply based on the third-party rating agencies as to how much your portfolio is complying with the ESG score. So the way I would look at it is that, yes, I mean, it's very difficult to give an absolute assessment as to, well, how much, what sort of evaluation or score that is attached to some of the companies. I think one aspect that we are doing increasingly more as it's more on the change. So when we go and visit companies, when we look at companies, we talk to them about the sustainability consideration in terms of what they have been moving towards or what has been the change since we last talked to them. I think that also reflects the, you can say, the emerging market nature of that you're pushing companies to improve. They are evolving companies. So whether it's on governance, whether it's on the way they run the business and sustainability, there's a lot of room. So the way we kind of are looking at a lot of our investments, the focus had turned more and more towards about how companies are changing, how companies are reacting to a lot of the demands from different aspects. And I'm going back to your question about, yes, I think we are actually waiting for more clarity from different fronts about what sort of a standard that the investment community will need to follow, a bit more transparency and clarity coming from the regulatory bodies as to what sort of a standard that I think the whole process, as I mentioned earlier, about this integration or convergence requires some sort of a starting point or a clear sort of a targets or starting point so that people can start to move towards that integration or the kind of a positive feedback loop that I kind of talked about earlier.
Thank you, Henry. Now, time is fast ending, but we have a few more minutes, and I want to go back to Hong in Incheon. really on the need, or whether we really need to take a new approach to building capital markets infrastructure. We often hear about this wall of cash out there, but how do investors find those high quality deals? And what's the role of multilateral institutions like yourselves in building capacity in those less developed countries?
Thanks. So I think probably I'll answer the second question, which will answer the first one. So I guess when I think about, what we've seen as we go in, a lot of these developing nations, and we work in 140 developed nations. So we've got projects across quite a few of these developing nations. And this is the general issue, is that we're talking about two new technologies. We're talking about countries that, historically hasn't had that infrastructure, and we're going in and trying to skip generations of technology or skip generations of, learning all at once. And but that means that you kind of have to bring everybody up to that level playing field. And I think Niall talks a little bit about getting the standards, and absolutely, but how do you get a country up to those standards and get that reporting when they're still talking about cooking fuel, right? And so it is such a stark difference when you talk to developed nations versus developing nations and what their considerations are. So in terms of multilaterals, what we do coming in is actually build that capacity at early stage. So there are, we tap into our readiness programs, our project preparation funds. So there's a variety of programs that we do just to get these developing nations and these nascent projects, just getting them up to speed with things like, just basic financial reporting or even just beta testing proofs of concepts, so that, that wall of cash, they can actually find at some point viable projects. I think that's the biggest issue, is that there is this huge wall of cash that's sitting there, and there's this huge demand that Henry talked about, but getting those projects, especially in developing nations, can be quite difficult without that initial capacity development. So that's I cannot underscore that enough. To bring that up to speed and to actually test out these proofs of concepts.
Thank you very much, Hong. And now I would like to pass on to Craig to have the last sort of comment of the first session. No pressure, but just within sort of one, maximum sort of 2 minutes, Craig. Obviously, New Zealand is seen as a bit of a leading light in the area of green and wellness and sustainability. So from a market development perspective, what are the lessons learned and best practices to share from New Zealand on the new economics of climate action?
Yeah, look, 2 minutes isn't going to do it, Adam. I think we could go for a couple of days on that one. But I guess one of the things that we recognize is that, green capital is trying to flow into a system that already exists. And so, all markets are not the same, for sure. And where the market need is also can be quite different. And for us, being kind of representative of an institution on the ground, actually trying to get the capital out the door and talking to, say, companies and our co-investors around the market, it's not just about where the capital need is for the company or the project. It's also about, if you will, the behavioral elements that have grown up around our traditional systems that are wholly embedded in institutions. And, we see those actually as being quite significant as well. We see a big layer of actually low carbon projects that never see the light of day as quickly as they could otherwise because of those behavioral issues. And so part of what we're doing at the same time is not just actually sitting there as an investor having those conversations, but we're also identifying these things in institutions who are evolving themselves and trying to tackle a very large sustainability agenda from many different angles, consumer preferences and changes, changing standards, changing regulatory environments. Boardrooms can find that very, very confusing. And so one of the things that we do is kind of bring a bit of clarity to that, because we are so mission focused around how our investment works, and so flexible in terms of what we can do to make it work. So coming to the table with a real flexible approach around capital structure, not being asset class specific, etc., allows you to approach the problem from a low carbon perspective first, and then to deliver whatever the investment solution is that needs to support that in that instance. And that's a very, very powerful thing when you're in the market. And that's probably
well, thank you, Craig. Well, I'd like to thank you anyway, and then Hong, of course, and Henry, and Marcin, and Niall for joining us, and Marjan earlier on. It's a bit of a whistle-stop tour of sustainability both in Asia and Europe, but hopefully that's whetted the appetites for the attendees for the later sessions who may take more of a deeper dive on specific issues. So once again, thank you very much. It's been a fascinating discussion, both in terms of global leadership, sustainable finance, and capacity building, and of course mobilizing capital markets. Now, keeping to our ambitious schedule, we will need to move swiftly on, and I'm pleased to introduce our second keynote of the day, which will be on the alignment of finance to a net zero emissions target. I believe we have Vice President Van Vies of the Asian Development Bank joining us from Manila. Ms. Van Vies is Vice President for Finance and Risk Management and is responsible for the overall risk management of the operations of the Office of Risk Management, the Controller's Department, and the Treasury Department. She assumed the position in 2016, and prior to that was a Senior Director at the German Investment and Development Corporation. VP Van Vies, I hope you can hear me. We can see you clearly. Please, over to you. Oh, I think there may be good.
I know. I need to unmute myself. There we go. Thank you.
How many times have we said that to each other in the last year?
Yes. Thank you for the introduction, Adam. So it's my pleasure to address this important and timely roundtable on net zero alignment of the financial markets. So, dear ladies and gentlemen, hold on. I need to press one button here. The COVID-19 pandemic has resulted in the worst economic setback for developing Asia in recent times. Like many others, the region has been hit with a triple shock: the COVID pandemic, the economic impact of a lockdown, and last but not least, the ensuing global recession. In the first time in the past 6 decades, the region's economy is projected to contract. And ADB forecasts that developing Asia's economies will shrink by 0.4% in 2020 on an aggregate level. The pandemic was a wake-up call, and the large investments to stimulate and strengthen the economies offer a unique opportunity to promote a sustainable, transformative, resilient, and inclusive recovery. In December 2020, leaders from the region virtually assembled and adopted an agenda to accelerate the implementation of the 2030 Agenda for Sustainable Development in Asia and the Pacific. Through 1, raising the climate ambition, 2, addressing biodiversity loss, and 3, tackling soil, water, air, and ocean pollution. This is just to show what's happening in Asia and the commitments being made. This keynote touches on 3 areas. I will start with a look at the current economic reality against which we need to achieve climate alignment of developing Asia's economies. Then I will outline the current status of alignment of financial markets in the PRC, and I will conclude with ADB's activities to support climate alignment for our member countries. The current reality is a journey from relief to recovery and to renaissance, a renaissance in which we transit to businesses and economies of the future. To provide financial relief, save lives, protect the vulnerable, and cope with the immediate socio-economic impact of COVID-19, the region moved swiftly and borrowed vast amounts to respond to the reaction. Key sources of funds were domestic and international financial markets. The latter worked well for some, such as Pakistan, Indonesia, and Thailand, but were less receptive to others, like Lao PDR. Multilateral finance institutions, such as development banks and the IMF, committed close to $40 billion worth of financing in just Q2 and Q3 of 2020. Another source of funds were debt suspension. 8 out of the 23 eligible least developed countries in Asia chose to participate in the G20 debt service suspension initiative, delaying potentially 7.6 billion of debt service payments to official bilateral debtors between May 2020 and June 2021. As a result of the activities, the region's fiscal space has tightened and the indebtedness has increased. Regional government debt over GDP increased on average by circa 10%, from 53.8 to 63.7% in 2020. In the relief stage, the lion's shares of the funds were used for release and recovery measures, including the strengthening of healthcare systems and provision of budget support to stimulate the economy. Funds from MDBs, in contrast to the European Central Bank program, had no green strengths attached. And as we know, the pandemic is still ongoing. Governments are balancing the priorities of access to vaccines, establishment of supply chains, and development of capacity for mass inoculation, with support of a sizable SME sector. However, the silver lining for the recovery is the increased awareness and commitment of society, governments, and private sector stakeholders on the need for economic growth and development in symbiosis with the planet and its natural ecosystems. Some parts of the financial service industry are already aligning with net zero emissions. Over 30 asset managers, representing over $9 trillion assets, have been committing to net zero emissions in their portfolios by 2050. Credit agencies started including climate and nature-related risks in their credit assessment. And last but not least, transparency requirements from, for example, the Task Force for Climate-Related Disclosures, the TCFD, and the shortly being launched Task Force for Nature-Related Financial Disclosures, the NFD, are being rolled out to improve transparency for both the bank regulators and the investors. With this, I will now turn to the current status of climate alignment of developing Asia's financial markets. The region represents about 43% of the global carbon emissions, of which China, India, and Southeast Asia each have a share of respectively 66%, 19%, and 12%. To give you some numbers of the investments required, the region has to invest $1.7 trillion annually in climate-adjusted infrastructure to achieve the implementation of both the Sustainable Development Agenda by 2030 and the Paris Agreement. So how do we get there? I will focus on the developments of the People's Republic of China, because it's the largest emitter, representing circa 28.7% of global carbon emissions. In September 2020, President Xi Jinping announced that the PRC would aim for carbon neutrality of its economy by 2060. And it's no surprise that PRC is already the most advanced among ADB's developing member countries in greening its financial system. According to China's central bank governor, China's outstanding green lending in June 2020 exceeded 11 trillion yuan, which is roughly $1.7 trillion equivalent. while its green bond market totaled 1.2 trillion won, about 173 billion equivalent. It's the second largest in the world. So what did they do? How did they get it done? So the government progressed integrating green consciousness in the financial sector over the past 5 years by adopting a top-down approach. Starting in 2016, the government published a roadmap for establishing the green financial system. The People's Bank of China introduced and further strengthened various macroprudential and monetary policy tools to promote green financial development. A year after, in 2017, the People's Bank of China and other ministries and commissions jointly issued the country's Green Financial Standards Plan as part of a larger financial sector development plan, detailing products and information disclosure standards, as well as green credit rating standards for financial institutions. What is remarkable and what could well be a key success factor in this process is the whole of government approach. Government institutions dealing with political reform, environment, agriculture, housing construction, industry, information technology, and science and technology comprehensively promote green finance. This approach was consolidated by mobilizing the cooperation, ingenuity, and energy of some of the country's greatest brains in finance, climate science, technology transformation, to improve the regulatory framework with impact on the real economy. For more detail, I kindly refer you to the Asian Development Bank Institute working paper, ADBI in short, from 2020 on regulating green bonds in the People's Republic of China. However, going forward, the main challenge will not be the promotion of green finance, but the disincentivization of financing brown, environmentally unsustainable infrastructure projects. With this, I would like to turn what ADB is doing to support the DMCs. In 2015, ADB committed to doubling climate finance from its own resources to 6 billion annually by 2020, a goal which we achieved a year ahead of its target in 2019. However, a lot has happened since, and tackling climate change, building climate and disaster resilience, and enhancing environmental sustainability is now a key priority of ADB's strategy, which we call our Strategy 2030. ADB has committed to deliver $80 billion in climate finance between 2019 and 2030. In addition, by 2030, at least 3/4 of every project we do will address climate change mitigation and adaptation. In 2020, however, we did not meet our goal due to the overwhelming share of resources that we dedicated to immediate relief and recovery responses for our DMCs. We recorded only $5.3 billion, and we will have to catch up in the coming years. Examples of ADB's support for greening financial institutions include the establishment of an NDC Advanced platform. The platform aims to improve the capacity of the DMCs to meet their climate objectives. By translating the NDCs into climate investment plans and develop climate action methods and tools for monitoring progress. A second example is the Article 6 support facility. This provides technical capacity building and policy development support to DMCs to improve their capacity and preparedness in order to gain access to new carbon markets, envisaged within Article 6 framework. And the third example is the Asia Pacific Climate Finance Fund, which was established to support the development and implementation of financial risk management products that can help unlock capital for climate investments and improve resilience. Finally, ADB also champions the introduction of innovative financial structures, which blend concessional finance and public sector finance to bridge viability gaps and catalyze private sector investment. For instance, ADB managed Asian Catalytic Green Finance Facility uses concessional financing to blend financing costs, de-risk private sector financing, and improve risk-commensurate returns. To conclude, I would like to acknowledge that we see a lot of positive development, but the level of ambition and the degree of transformation are still insufficient. In the renaissance of our economies, in which we learn to live in harmony with nature and successfully achieve the alignment of financial services with the world's climate and sustainable development goals, everyone has an important role to play. The governments are responsible for the creation of the intangible infrastructure. For example, the regulatory frameworks establishing conducive ecosystems for these businesses of the future and practices of the future. Financial institutions are responsible for financing these very businesses and undertakings. Asset managers and investors should carefully select investments, focusing on sustainable business or businesses with a solid transition plan based on reliable and transparent information. In closing, I would like to cite Sir David Attenborough, who recently said that if we continue on our current path, we could face the collapse of everything that gives us our security, food production, access to fresh water, and ocean food change. We cannot let this happen. Thank you.
Thank you very much, Ingrid. You'll have noticed we're much like the Oscars or Golden Globes, where they start playing music towards the end of a speech. So thank you for bearing with us on that. But it's very heartening to hear how development banks like the ADB are taking a lead and supporting developing countries to both raise and realise their climate ambitions. I'm also glad you mentioned Sir David, and glad nature was mentioned as it was World Wildlife Day yesterday. So thank you very much, Ingrid. Now moving swiftly on with the programme, I'd like to pass on to Tamara Singh, Head of Asia Pacific for UNFIF, based here in Singapore, to guide us through the next panel.
Hello, everyone. Thank you for attending today's very, very impressive symposium. I've been very pleased with what we've heard so far. There have been many insights gained. With me today, I have a very rich, experienced panel of expert speakers from all over the world with a much improved carbon footprint for this occasion. We have people attending from Australia, New Zealand. We have people attending from China and across APAC, as well as Scandinavia, Germany, and even the US. I'm going to take the opportunity to ask them to introduce themselves with an introductory question. I'd like to invite our speakers, please, to introduce yourselves and to also share your organization and your own philosophy and on how you want to approach social going forward. If I could please start with Andrew Cross, Chief Financial Officer of the Asian Infrastructure Investment Bank.
Thank you very much. What a pleasure to be here, and my thanks to the sponsors, UNFIF and DZ Bank, for putting this together. I felt hugely intimidated by the quality of the panel that I share, and I'm as much interested in what they have to hear as probably the audience. I have the privilege of working for the Asian Infrastructure Investment Bank. I think the name very clearly gives away the region that we work in, which is Asia, and the asset class that we're focused on, which is infrastructure. The bank was set up just over 6 years ago with 57 founding sovereign members and has grown very quickly today where we have 103 sovereign members. And AIB has a lot of similarities to the Regional Development Bank in Asia, the Asian Development Bank, and obviously similarities with the founding MDB, the World Bank Group. In terms of social and sustainable development, I'd probably emphasize 4 main areas. It would be mandate, sustainability principles, thematic priorities, and financing targets. How do you bring it to life? So the mandate is very clearly set out in the articles, which is a public document and available on our website. And it's around fostering sustainable economic development, creating wealth, and improving infrastructure connectivity in Asia. It's also about promoting regional cooperation and partnership, which seems like such a strong message given the experience we've all had of COVID-19 pandemic through 2020 and 2021. We endeavor to bring that to life through 3 sustainability principles that are investments in infrastructure must be financially and economically sustainable. They must be socially sustainable and inclusive, and they must be environmentally sustainable. I think many of those will resonate with the audience and with the other panelists. We have 4 priorities in terms of how we target the infrastructure investment. It must be green. We focus on connectivity and regional cooperation. It must be technologically enabled infrastructure. And we're also looking to encourage private capital mobilization, where so much of the capital that is available from investment currently resides. And the last part, with your indulgence, would be the corporate financing targets. How do we bring that into reality? So we have a 50% climate financing target by 2025. That we endeavor that 25 to 30% of our investment by 2030 will be cross-border connectivity. And that also by 2030, as part of our 10-year plan, we will have a 50-50 split between public sector investing and private sector investing. I think mandate, sustainability principles, thematic priorities, and financing targets, those 4 layers sort of have built on the very 3 catchphrase themes that President Jin announced when the bank was inaugurated just over 5 years ago, which was to be lean, which was to be green, and which was to be clean. And I'll stop there. Thank you very much.
Thank you, Andrew. If I could please ask Antti Kantio, who is the head of funding for Munifin, to share his views and his philosophies.
Yes, good morning and afternoon, everyone on the line. And many thanks for the invitation to this very interesting panel today, and greetings from snowy Helsinki, Finland. So my name is Antti Kantio and I'm the head of funding and sustainability at Munifin. Munifin is the local government funding agency in Finland, and our customers include municipalities, cities, as well as social housing companies. Our total assets are roughly 44 billion euros, and we only finance projects in the public sector. Currently, we have 2 sustainable products we offer, green and social. As many of you know, we have been an active issuer in green bonds since 2016, and we have roughly 2 billion euros of outstanding green bonds at the moment. We also became the first Nordic credit institution to issue a social bond last year. And very briefly, just to summarize, what were the main points that motivated us to become a social bonds issuer? So first, our role in the Finnish society is very important, as our main customers are local governments and the social housing companies. And we feel that our customers are at the center of how they can improve welfare and equality in Finland through their investments. Then we all know what's happening on the investor side. Both green and social bonds market are booming. So we also felt that this new type of product would be a good addition to our sustainable bond offering. The products that we have in place, they have also been designed in a way that they can promote the sustainability goals set by the Finnish government. Based on this goal, Finland aims to become carbon neutral by 2035. And in addition to that, Finland aims to promote equality, education, culture, and innovation. And we feel that our sustainable products promote well these national goals. And a short teaser here, we're also going to release our first social bonds impact report today. So we are very excited about that. Thanks a lot, and I look forward to the interest in this discussion today.
So staying in Europe for the time being, Christian Kopf, Head of Fixed Income from Union Investment. We would love to hear how Union Investment think about investing in social.
Yes, thank you very much, and welcome from sunny Frankfurt. We've got the first rays of spring sunshine here that are reaching us. So Union Investment is part of the cooperative banking network in Germany. And what may come as a surprise to some of you is the second largest asset manager in Germany and market leader when it comes to sustainable investments with more than 70 billion of sustainable assets under management. We've got a long history of investing in ESG-themed funds that stems from the fact that the church banks in Germany are part of the cooperative banking network, and they've been demanding ESG products for more than 40 years. So we've had with more than 40 years of experience in setting up sustainability-themed funds and ethically SRI funds. Now, the social aspect of ESG is an integral part of that, and we have a number of filters that we apply, social filters that we apply to this product offering. Among them is the ILO standards. In addition to that, we're very active in the nascent market for social bonds. I think we're the largest holder of social bonds right now in Germany. And I would say that we're on a journey right now towards a deep integration of ESG aspects into all of our product offerings. That is something that is ongoing, and the social part plays an important role in that respect.
Thank you, Christian. Catherine Palmer, it'd be lovely to hear from a financial risk management perspective at the New South Wales Treasury, and also from your experience as a New South Wales Sustainability Bonds Committee working group, how you might feel about social within your remit.
Great, thanks very much, Tamara, and it's really lovely to have the opportunity to be with everyone today. So I hope that everybody is enjoying the conference and is going to be able to get a lot out of this conference that's been organised for you. My name is Catherine Palmer. I work for New South Wales Treasury, which is representative of one of the states of Australia. New South Wales is actually around a third of the entire GDP of Australia and about a third of the population, just to give you some sort of context of scale. I think that like many representatives here who might work for government, social is actually part of the core business of government. So deriving better outcomes for the people of New South Wales or our state is part of that remit. So it's reflected in our articulated purpose. So providing central agency leadership is what we desire to do so that the people of New South Wales have access to services and infrastructure that deliver outcomes based on social and economic benefits. In New South Wales, roughly 50% of our expenditure is on education and health. And like many government institutions, ours has been faced with very specific challenges over the last 2 years. So not just the recent COVID epidemic, but in Australia, you may have been aware of, for instance, we suffered from droughts and bushfires just before going into the crisis. And this has both economic, environmental, and definitely social impacts when you're looking at crises like these. My role is working in New South Wales Treasury, leading the financial risk management team, which has a whole of state remit for looking at the balance sheet. There are a number of work streams under this area, including financial assets, liabilities, fiscal strategy, and sustainable finance. And my personal involvement in this has been in establishing with a group of people the Sustainability Bond Program, which we set up around 3 to 4 years ago, which was quite leading at that time. And I would say that the maturity increases every single year that we work in the sustainability field. And I would say that social is perhaps one of those areas that has been moving ahead quite rapidly. So we established the Sustainability Bond Program for New South Wales at a time when most entities were establishing green bond programs only. And the view there was to reflect part of the business of government being delivering to the people of New South Wales. So therefore it has those social elements. And also being able to shine a light, I guess, on the policies and priorities that the government had that was broad, including environmental, but also social. On the debt side of the organisation, I used to work for the funding arm, as some people on this call would recognise. So I used to work in the funding team raising debt under the Sustainability Bond Program, as well as the general program. And that was actually an important initiative for us to be able to shine a light on what the government was doing in terms of its policies and how that was consistent at the overall issuer level. On the asset side of the organisation, our financial services partner, TCorp, actually manages a large amount of investment funds, so over $100 billion. And they take a strong view in managing ESG issues that's critical to achieving sustainable investment outcomes. We see ourselves as stewards of those assets that are entrusted under our management and are active owners in that space, so integrating ESG into investment decision-making, including such practical initiatives as climate stress testing of portfolios, proxy voting, and collaborating with industry groups. So it's a very broad remit. My experience is probably more on the debt side, and more recently moving across to the New South Wales Treasury organisation and looking at that whole of state level from an ESG space and whole of state balance sheet.
Thank you, Catherine. And I think you've just illustrated the wealth of this panel, where we've got investors, investees, creators of programs, innovators of product, lots of experience. And continuing that, we have Heike Reichelt, who is the head of investor relations and sustainable finance for capital markets and investments at the World Bank. Heike, could you perhaps share how the World Bank approaches social?
Sure, thanks very much. It's great to be here, and it's really nice to hear and see everyone on this panel. So the World Bank is an international development organization, and we have twin goals, which are social goals, that we work towards. One is eradicating extreme poverty in our member countries, and the other one is boosting shared prosperity. So the second goal addresses income inequality. And we work with our member countries by financing projects and programs in many different areas. Education, health, sustainable transport, renewable energy. Every single project is designed and only exists because of the intended purpose, because of the goals it is designed to achieve. We finance our activities by issuing bonds in the capital markets. And I must say the World Bank Treasury is the treasury for two issuers. One is the World Bank, or International Bank for Reconstruction and Development, IBRD. And IBRD has been around in the capital markets for over 70 years, has a funding program of around $60 billion a year. And the other issuer is an organization that's 60-something years old, but relatively new to the capital market. And that is the International Development Association, or IDA. And both issuers are legally separate, but they both work with government. The difference is really the group of countries that they serve. IBRD serves middle-income countries, and IDA serves lower-income countries. The program for the World Bank, for IBRD, is more established because it's been around longer. And what we've done is we've been engaging with investors, again, around the purpose of the World Bank. And we're talking about social on this panel. As I said, we have social goals, so everything somehow works towards social. We did, a little over 10 years ago, introduce the Green Bond label, just to focus on climate, and that's the challenge of our generation. And everything that we issue supports the sustainable development activities, so we use the label Sustainable Development Bond. And we've really, we've changed how we interact with investors. We have a lot of reporting on impact, and I look forward to the discussion in this panel.
Thank you, Heike. I love how we have between us several centuries worth of experience. Marika Ward, Senior Credit and ESG Manager at the Liquid Markets Group in Queensland Investment Corps. I think you'll be adding to that tally. If you would introduce your principles and your philosophy on social. Apologies, Marika. I can see that your audio is on, but we can't seem to hear you. Would you mind trying to mute and unmute yourself? I'm afraid we've lost Marika for the moment. Perhaps while the engineers work with Marika to sort out the audio, I could perhaps start off our conversation for today, and perhaps we can hear from Marika a little bit later on. Perhaps Heike, if you wouldn't mind, I know you've just shared with us really the generations of experience the World Bank has. And one of the things we spoke to was in our warm-up call was really the development of metrics and standards, and understanding that how the World Bank has driven some of those conversations. In your view, I was curious, what would the best practices be to adopt a standard, and how has the thinking in that space evolved?
Sure. Well, I mentioned a little bit that that we're engaging with investors, so our conversations with investors have really changed over the years. I think keywords here are transparency and harmonization, but also making sure that we don't lose the big picture. So you mentioned that we were involved with setting some standards for reporting. When we issued the first green bonds, we got together with other multilateral development banks and set a template for reporting, trying to find certain metrics that we could all agree on and a way of reporting to try to make it easier for investors when they hold different bonds to somehow aggregate and compare and make sense of things. It's extremely difficult to do that in a way that makes sense. But we're focused on providing transparency data. Now that we've expanded to the entire balance sheet for sustainable development bonds, as I mentioned, that covers many different sectors, and each sector is going to have different metrics. There are a lot of resources out there for investors. There are ESG research firms. There's a credit rating agency. We work through ICMA and various working groups to try to come up with these harmonized metrics. But what is very important is that we sort of move beyond, or we realize that scores can't be everything. You know, we can't rely on checklists. Things can't be squeezed into boxes. So looking at strategies, understanding, how issuers operate overall. We heard Andrew going through very clearly how AIIB operates in the principles. I think from an investor perspective, it's just important to understand how issuers operate and not focus too much on just numbers and data, but have a more holistic view. Just one thing I want to also add is this counting of bonds. We often hear the size of the market of sustainable bonds, labeled bonds. And this is really just a small piece of what's actually being, or how sustainable activities are being financed. So it's not true that just 1% of the bond market is sustainable bonds. That might be what's labeled or what's counted. But of course, the amount of bonds that are being issued to finance sustainable activities is much larger. So that just goes to my point that, we can't, I guess, we have to see the forest and not just the trees. So maybe I'll just leave it there.
Great, thank you. And Marika, I think we might have you back now.
Can you hear me now?
Yes, we
Great.
can.
Sorry about that. I'll just quickly reintroduce myself. I work for QIC. We're an Australian headquartered fund manager owned by the Queensland government. We've got around 83 billion under management on behalf of both private and public sector clients. We invest in a range of alternative assets like infrastructure, property, private capital. I'm on the fixed interest side of the business, so the liquid markets group. And within that group, we believe environmental, social, governance factors can have a material impact on both the operational and the financial performance of the issuers that we're investing in and the counterparties we're dealing with, and therefore on the returns of our investment portfolios. And so while we don't manage specific ESG mandates, we have your sort of typical ESG exclusions through our portfolios. But our investment process also really embeds ESG considerations as part of our bottom-up credit approval and our credit monitoring process. And, you know, as a credit analyst, when we're looking at investments, we're really sort of looking for any E or S or G issue that might impede the ability of the issuer to repay us. And when we think about sort of social bonds, we're including them in our vanilla bond portfolios, along with things like green bonds and sustainability linked and sustainable bonds. We're including them in the portfolios where we're comfortable with the structure, where we're comfortable with the issuer, where there's a reporting framework in place, and where the valuations make sense. So apologies for the technical difficulties there, but hopefully sort of we're back and running.
Absolutely, and ready to roll. I think what you just explained actually echoes the sentiment that Heike had, where you have these products, but you're treating them as vanilla bonds in your portfolio. And I was quite struck by that because it really, to me, was the antithesis of what we've been hearing about the kerfuffle around greenwashing. Where we all think right now there's an overstatement, but actually perhaps people are actually underplaying just how green they actually are in some cases. Marika, it's also interesting for me because as an investor, it's quite the idea that investors are here to drive the right behaviors is not always the most natural. I have to admit, not everyone looks at finance and thinks finance is the way to solve an ESG issue. So as an investor, what do you think the impact and influence has been of that community in driving social outcomes?
Oh, look, I think it's big, and tomorrow it's growing. Look, as an investor, we've been used to, I guess, seeing social bonds from supranational issuers. And even without sort of compulsory frameworks in place, we've never really had to think deeply about whether it made sense for that sort of issuer to be funding social projects. But I think we're sort of probably really seeing some interesting market developments over the last year that have made investors more comfortable with the concept of funding social good. And, we were talking earlier offline about the impact of COVID, and I make these next comments, I guess, absolutely acknowledging that in Australia, COVID has not impacted us as deeply as it has in some other regions. So, we know that we're very fortunate, but, if the pandemic can bring any positive learnings for us, I think what it's done for us is given people an opportunity to reevaluate what's important, as humans and as workers, of course, but for us as investors too. And if I think back over the last year or so to the bondholder updates we've participated in, we've had many companies that have led off the update by talking to us about the impact on their staff and their customer well-being. For some of them, we heard them talking about S factors for the first time ever. They may have mentioned health and safety data in the past or had that one slide in their presentation. But to be perfectly frank, I think it took a pandemic for some companies to acknowledge the importance of their staff and their customers. And I think, over the last year, we've seen ESG engagement really step up. Locally in Australia, we've had company executives removed from their positions because of investor pressure, and that pressure's been because of non-financial transgressions, including social issues. I think the other thing over the last year that's had an impact in Australia is the Modern Slavery Act. We've got the reporting requirements underway at the moment. And what's really interesting about that piece of legislation is that you have to look at your operations and your supply chains, obviously. But the legislation extends to looking at whether you're financing slavery or the risk of financing slavery via your investment activities. So that's really forced investors to think about the social issues that they might be financing. Now, that legislation isn't a penalty regime at the moment, but the reporting is public, so there's a level of transparency and it raises reputational risk. And sort of thinking about changes over the last little while too, I think we've really got to acknowledge the impact of the UN SDGs. So what probably started as a noble concept a few years ago has really gathered momentum. And now, I can't open an annual report where a company's not talking about how their activities are aligned to the SDGs. And, perhaps there's an element of SDG washing in that because we don't have a compulsory reporting framework. But I think what the SDGs have done is that they've really helped to legitimise social issues for bond investors. And they've helped us to see the impact that we can have through our financing choices. So I think, we've come to this realisation that with the money we're investing, we can actually impact people. We've got tangible examples of how we can support social factors. There's some voluntary frameworks like the ICMA social bond principles. In Australia, Catherine and I have both been involved in the Sustainable Finance Roadmap. And that came out late last year, making recommendations that address social financing issues. So I think all of these things have brought prominence to S, and in turn, the growth of the social bond market. I think, still investing in S has a bit of an element of faith to it. The impact reporting is more qualitative than quantitative. If we think about what would happen with the misuse of proceeds, as an investor, that's not an event of default, so that puts more risk on me. But I think, developments in the last year have certainly made us more comfortable that social bonds have a place in the investment universe. And I think with social bonds, at least we're solving problems, whereas sometimes when I'm thinking about a green bond, I worry that we're not removing brown electricity sources, we're just adding to the overall electricity stock. Whereas tomorrow, with social bonds, I don't really have to worry about adding to a problem. So I think that's, that's the benefit.
Yeah, and I think that's actually a really interesting point, and one that was touched on in the earlier panel that I was going to say about for later around, really is the act of exclusion helping, or is it going to be, is it better to hold and work with someone, which is much more the social aspect. But I don't want to digress too far too quickly. I'm sure I'll do it in the end. But one of the things that struck me what you were saying was that in this idea about considering where the risk sits between the investee company or the investor, to me, if I think about the due diligence that's involved and the financial processes we have when we make our investment decisions, one of the things that implied to me is a resource burden. And so you mentioned that you've been working with Catherine, who I'd like to call on, because Catherine, I know you've been part of developing a program to look at social impact. And it'd be interesting for me to understand what the pain points were, what the challenges you faced were in approaching this.
Thanks, Tamara, and maybe just picking up on some of the points that Mareka has also articulated. So when we set up our program, we wanted to make sure that we weren't going to be accused of greenwashing or social washing, etc. And all the issuers on this call also would have gone down this path where how do you make sure that you preserve your reputation for actually doing what you intend to do, which is achieve a program that has a positive impact from an environmental and a social outcome perspective. So we did look to align our program with the ICMA principles that Mareka highlighted earlier. So that's the social bond principles, the green bond principles, and the sustainability bond guidelines. So that there was that rigor and testing around that. We also, with the green bonds that we issued, we had Climate Bond Initiative certify those bonds. So you had a known set of standards that investors could look at. And finally, we did align with the UN Sustainable Development Goals. So once again, something that people have recognised quite broadly in terms of being able to say, well, not just this is the tile of the UN Sustainable Development Goal map, but where do we go and where are we working towards? But you're absolutely right. At the start of this program, we actually did our first issue as being a green bond. And it was because, to be perfectly honest, in our first foray, we wanted to make sure that it was efficient and easy from the perspective of setting up something new and from scratch. And that's something that going back 3 or 4 years ago for us was relatively new. So it is something that we have to allocate more resources to. If we issue a general purpose bond into the market, we don't have the requirement to do the annual reporting, and we don't need to earmark assets and projects to that specific bond. That business still goes on. So as a government, we need to spend to be able to fund infrastructure and the general programs that we have. but to issue a general purpose bond, we don't have those requirements. In Australia at the moment, there's not as much of a pricing differential. You could argue that there is when you look at the secondary market levels of bonds, but when you go to issue those bonds, generally speaking, it's in line with the issuer's curve. So the issuer, as well as the investor, takes on additional resourcing costs to either assess the projects that are being put into the program and earmarked, to report on those on an annual basis. And I'm sure Mareka will attest to the resources that are allocated from the investor side to be able to analyse those reports and analyse the quality of that outcome. Does it really stack up from an investor's perspective? So on both sides, often you meet in the middle, which is on the curve. My point in all that, though, is that when you look at green bonds, the taxonomies and the standards are more developed than what the social side is. There's definitely been evolution and there's a lot more understanding around that. But social projects for us, notwithstanding the spend that the government does on social activities, often the projects are quite a bit smaller. So if I look at New South Wales, for instance, over the next 4 years, we will be spending around $107 billion on infrastructure over that 4-year estimate period. Now, that's a large amount, and a good proportion of that actually comes from transport. So one of the major assets in our pool of sustainability bond assets is actually a rail line, or two rail lines, actually. They're large-scale assets. They require debt funding, and it meets the principles, the standards under the Climate Bond Initiative. And that is getting cars off the road, different mode of transport, and also the projects themselves have other credentials around them that actually support an environmental and a social outcome. When it comes to the social assets, though, for efficiency, we looked for the larger assets to make sure that our resourcing and the time commitment allocated to it was well spent. We want to do this. We want to encourage transparency around our programs and our impact, but we also want to make sure that it's efficient. So the sort of programs that we put into the pool of assets included transport access programs. So that's about accessibility at train stations. So renovating train stations so that people that might be vision impaired or mobility impaired can actually access train stations a little bit more easily. That was a larger scale program. And similarly, one of the other assets that we have in there that is more socially aligned is spending on new schools and renovated schools, which enables the broader population of children to be able to attend, whether they be in a rural area or an urban area. We're able to support those sort of activities. So those are the sort of assets that we've identified. They're larger in scale, they're more efficient to report on, and we've been able to easily identify the population groups that benefit from those sort of assets. So coming back to the crux of your question, we need to keep in mind as an issuer what those costs are, but I don't want to overplay the costs either, because the longer term benefit of being able to get a better social outcome, things that are measured and monitored, actually bring you to a better place in the longer term. So I don't want to end this on a negative at all. I just want to say that as somebody who has worked on the issuance side, we do need to make sure that there are efficiencies in being able to do that. So aligning with those sort of metrics and standards and identifying larger assets is one of the ways that we've attempted to do that.
No, I think that really resonates for me. So earlier this year, I was able to work on a series of roundtables, and at those roundtables, we had practitioners from the private organizations, the ESG specialists and consultants, and they expressed frustration about how in the lead up to developing taxonomies and standards, they were frustrated that they sometimes felt they weren't able to lead positive change or just do the right thing. And one of the things we heard about earlier from, I think it was Marcin Bill of the European Commission, was around how, he acknowledged that there were very different taxonomies being developed across the world by people with different agendas and priorities, and that was still better than not having those taxonomies in place, because by having them, you were able to help direct funds and then create the standards that would then enable capital flows. So with that in mind, and drawing on what Christian said in his introduction around the long history in Germany of having social products, perhaps you could hear a bit about what you think about the need for standards. Do we need to wait for these things to get going?
Yeah, well, thank you very much. So Germans are very good at standard setting. I mean, we've got norms for everything. Yeah, it's in our DNA, really. And I think that Germans have also developed social bonds avant la lettre, if you wish, with the Pfandbriefs that many of you may be familiar with. So we've had covered bonds in Germany since 1769. This is a standard that was established by decree by Frederick the Great, King of Prussia at the time. And we've had our 250th birthday already of the German version of social bonds in 2019. And then there's another important milestone in terms of standard setting. That was the Mortgage Bank Act. Was an act of Parliament that came into power in January 1900. So we've had a very long, uniform legal basis for this type of social bonds in Germany. And I think that these covered bonds, to some degree, they are social bonds because they serve to achieve SDG goal number 11, which is to ensure access to adequate, safe and affordable housing and basic services, and to upgrade slums, which we also had in Germany, lamentably, many years ago. So this is where the covered bonds have come into play. And we analyze the housing share of the pool of covered bond purchase and take that into account when we calculate the ESG score of those issues. Now, in addition to that, we now have a very large pool of social bonds in Europe, which is dominated by the European Union issuance. You mentioned, Tamara, that it has been discussed earlier today. And we think that we have north of 100 billion of those bonds by 2025. And these are bonds that serve to help finance national unemployment schemes in the European Union. So this is a very important aspect of the social bond market in Europe. With respect to standard setting, we are actually very happy with the ICMA social bond standards, and I would like to mirror what we heard earlier on from Catherine. I think there is really no need for a separate set of standards here. The ICMA social bond standards are based on the green bond principles, and they provide a very good basis, I think, for analyzing the different issuers. They have 4 points: use of proceeds, project evaluation, the management of proceeds, and then the reporting. Now, for us, there are two things we look at very carefully when we analyze those social bonds. The first one is we would like to see a second opinion from a reputable agency on the planned issue. And I think that's a very good complement to what we get from the red and from the prospectus. These agencies have a very good cross-sectional overview of the various issue frameworks. And, that's what we look at. We want to see a clear framework from the issuer in order to prevent this social washing. Currently, I really don't see an additional need for standards that go beyond the ICMA standards. I think that's a very good example, the ICMA standards of an industry that is organizing itself, setting its own standards, and I think it's working very well. So I don't think we need another type of framework there. Now, I would like to say maybe one word on the future of social bonds. And I think that the social bonds we have in Europe are a wonderful thing. They're going to be very big, and they're becoming a very important portion of our mandates. But I think that social bonds can go beyond that. And the issue I'd like to mention here is a lot of our funds are unable to invest in a lot of the emerging economies because those countries do not meet basic standards that we set with respect to the rule of law, to corruption. We look at the Transparency International Corruption Perception Index and a number of other indices which make it impossible for us to invest in a lot of those countries. However, if those countries or if entities in those countries issue social bonds, that could provide an avenue for us, for our sustainability-themed funds, to approach those countries. And one of the issues I'm really fascinated about right now is what the Banque West Africaine de Développement is developing here. And they just came out with a social bond earlier this year, which allows us to invest in countries such as Benin, Côte d'Ivoire, Mali, Niger. These are places where we have not been able to allocate so far. And yet, with the social bond that we have from the Banque West Africaine de Développement, we're able to invest in projects that work to achieve affordable social basic infrastructure, and also deal with gender issues, woman-owned as small and medium-sized enterprises. So I think this is I think the social bonds can sort of serve as an avenue to invest in countries that are otherwise not eligible for our sustainability-themed funds. Yep.
Thank you. And actually, funny enough, that seems to be a bit of a European consensus. That was also one of the views that was shared earlier on today, where because of the thematic flows towards social, there was now an opportunity for corporates to draw on that trend and attract financing. So Marika, I guess if I could put this one to you again, and then perhaps go back to Antti afterwards to hear another European opinion. But Marika, perhaps when we spoke, you mentioned the sort of carrot and the stick ability of an investor to incentivize behaviors. Would you perhaps like to share your views on that?
Certainly. And look, I'll start by echoing what Christian said. You know, we think the ICMA social bond principles are adequate and a very good guide for investors. So, you know, absolutely agree. There's, you know, an investor-led solution is fine here. We don't need another framework to follow. When we're looking at social bonds, we're first and foremost looking at the issuer. So does the issuer meet our ordinary sort of qualitative and quantitative investment requirements? I mentioned earlier when we're looking at the supranationals, we probably think that social projects are more sort of aligned with their purpose, so it's within their DNA. So, you know, we would consider a social bond where there wasn't the ICMA framework. There's not many of those, but, you know, we don't necessarily think they need a framework, and we're more comfortable not having the second party opinion, etc. If it is a corporate issuer, so someone where you do have to think about what their purpose is and why they're issuing a social bond, well, then we do require them to be aligned to a framework. If it's a green bond, it's got to be CBI, it's got to be ICMA. We also then prefer them to have the second party opinion. We're requiring them to be doing impact reporting. I think there's been some issues with impact reporting as far as timeliness goes. So what we've been saying to issuers that we've been talking to is, you know, try to line it up with your general reporting timeframes, so your financial reporting timeframes. Picking up on a point Catherine made earlier, we're trying to sort of, you know, make sure that what we're putting funding to is what we thought it was going to be, but we don't want it to become so burdensome that it stops issuers from even thinking about sort of going down the social bond or the green bond sort of investment process. So if you're a corporate, we want some sort of independent audit, and we want absolutely impact reporting. And, you know, those impact reports on the social bond side are a lot more qualitative. We're taking that data and we're putting it into an overall report on what our fund looks like and, you know, the sorts of projects it's supported. And what we're finding is that's opening up conversations with our own clients. We certainly sort of mentioned we don't have a specific green bond or social bond mandate, but we certainly haven't had any clients sort of questioning why we're putting these sorts of bonds into the portfolios.
That's lovely. I think it's really nice, and it touches on what Heike said earlier about the sort of journey between investor and investees to sort of grow together, start getting towards a co-creative kind of environment. And that's actually something that Antti and I had started speaking about, because we had touched on some of the sort of innovation we'd observed in the various sectors. We talked a little bit about the use of human-centered design and similar. Antti, if I could ask you to share your views on how the approach of capital markets towards social might innovate from what we've seen in recent years with the move to grow products in the environmental space.
Yeah, well, many thanks, Tamara. And I think this innovation aspect is very important once because we have seen fast development in the green bonds market in the last few years. And as we all know, the social bonds market is still growing very fast, but it's on a developing stage. So it's not there yet. And also we all know that social itself, it's a bit more challenging to define and quantify in terms of impact. One thing we also need to remember is the importance of social impact bonds, or SIBs, because they were really the ones that started the development of social bonds market. And in these social impact bonds, quantifying impact is much easier, as the goals or KPIs are clearly already set in the beginning. But when it comes to innovation in social bonds, I think the collaboration between different stakeholders is very important. Private sector, most likely, they have more resources for R&D and technological development. However, role of the public sector in implementing innovations becomes important because they have very large-scale investments in place. And then if you look at our operations at Munifin, we have many social finance projects where innovation has played an important role. And we always want to encourage our clients to think out of the box and also come up with new ideas, how the investments could be improved in terms of user experience, for example, and also how they can promote our 5 key components when we grant our social finance. And those are equality, communality, welfare, safety, and regional vitality. And I'll just give you 2 examples here. For example, in some of our social finance projects, they have been focusing on the sense of communality in the past. And for example, loneliness is a big problem in Finland, and especially for the older ones. And also some people are at the risk of social exclusion. So then communal living can be promoted in many ways. For example, we can have shared facilities in the buildings, cozy communal living, and so on. So places where people can actually meet. And then another example can be in terms of education. We look at the building not only from the teaching perspective, but also from how the building could be then used after the school day is over. So then what kind of alternative use can be done in that building? And I think that's also one pioneering development in Finland. So putting all these things together, I think there is already a lot of innovation taking place in the market. It is developing fast. We just need to promote these new innovations and make them visible for everyone. And also we can do it through reporting and other channels that we use.
Thank you. I love that very Scandinavian reference to coziness. And having thought about, the idea of being in isolation, of course, and spoken about the idea of being in quarantine, I'd like to ask Andrew, who is currently, I believe, in quarantine, to share a little bit about his experience having been spent quite a lot of time considering sustainability. What do you think the lessons learned have been by the industry in developing the products and continuing this journey? I think you're on mute at the moment, Andrew. I think it's the curse of the controls.
Can you hear me now?
Yes, we can.
Excellent. I'm going to stay away from the controls. I wonder if there are any new lessons to be learnt. That essentially all the lessons lie in the past, and it's just a matter of actually discovering them. And I think our space is renowned, the fixed income space is renowned for a healthy dose of skepticism, which is not necessarily a bad thing. But I remember working on the IFC's first green bond, which built off the work that Heikki did at IBRD when they issued their first green bond. And Heikki will know the dates better than I, but this was sometime around like 2008, 2009, somewhere like that. And the IFC, when it came to do its first green bond, the motivation originally came out of talking to what used to be called SRI investors. And some people will remember those days, socially responsible investors, predominantly focused on the equity side, and there were some small fixed income portfolios. And I remember the conversation we at the IFC had with SRI investors was, well, look, everything we do is sustainable, everything we do is green, everything we do in some way or form probably matches some of the, the basic Quaker principles that lie at the heart of many of those SRI funds, right? And I remember, and so it's interesting now, leap forward, and I look at the SEC prospectus for the AIB, and basically we don't issue green bonds, blue bonds, theme bonds. We only issue essentially sustainable bonds. But when we had that first conversation with what we thought would be a receptive audience, no, didn't fly. I remember rightly getting a lecture from numerous investors about fiduciary duty. And every one of them had a slightly different definition of what they meant by it. But generally it was, no, we don't want to buy. And so we issued our first green bond, 200 million. It was to actually support, in some ways, the IBRD bond to add momentum to the market. And picking up maybe, as you said, I think you said coziness, a lovely theme. I think we took a very Australasian theme to our approach and went, let's have a go. Let's try. Let's not let perfect get in the way of good enough. Let's have a go. Because so often you get this chicken and egg debate. We can't do bonds until we've got a standard, but we can't issue the bond because we don't know what the standards are. But we don't know how they should price, but they shouldn't price at a premium. But it's costly to issue the bond, so they should price at a premium. And I think we just basically went, using your term of faith that got mentioned too by Mareike and Catherine, we just had faith and went, this is the right thing to do, we'll do it. And I left the IFC many years ago, but I now see that they do benchmark size green bonds. I mean, who would have thought that in 2008, 2009? I think we also have to be a little bit careful. I'm going to challenge a little bit this sort of European-centric view of standards, because the EU's taxonomy, whilst being a wonderfully 600-page contribution, did follow after the PBOC's much, much more concise 14-point contribution in 2014, 2015 by Ma Jun, who's one of the contributors on the earlier side. I think we also have to be a little bit careful that we assume the lessons should come from the so-called developed market to the so-called emerging market. And I think emerging actually does many of our countries a disservice, because we only have to go back to the global financial crisis to wonder what the developed market actually does teach the emerging markets. So I think a healthy dose of cynicism is not a bad thing. I don't necessarily think there are new lessons. I think you build a large tent, you canvas momentum, you get people involved, you gradually over time move to greater definition. And sometimes you accept that there are competing views around, is standardization necessary? You know, we have hundreds of thousands of bonds listed on Clearstream or Euroclear. Very few of them have much in common with the other bonds. And yet, oddly enough, investors are still turning up and buying those bonds despite the fact that they're not standard. So I'm having fun a little bit to challenge it. I don't discount the fact that standards are important. You know, I think in both pounds and kilograms. So I think we can survive in a world where we do have standards or competing standards. And I think also the work that ICMA did with NAFME on developing standards for what is actually the largest green bond market in the world in China might again be a bit of a wake-up call for people that these things can move on without necessarily pining from the developed market. So I think the lessons are there. I think they're around faith, have a go, momentum, build a large enough tent. And I think also the other thing that I would note is that when I was involved in the first green bond, and Heike predates me in her experience, I don't remember there being a massive proliferation of ESG experts. I don't recall there being huge numbers of SRI, ESG rating agencies that were opining. I don't remember there being a large number of second and third parties who were going to tell me whether this was appropriate or whether it was done in the right things. but it's wonderful to see the proliferation. It's wonderful to see the enthusiasm, because in essence, and maybe I finish on faith, in essence, this is all a good thing, right? Whether it's a green bond, brown bond, blue bond, theme bond, social bond, gender bond, and so on. And Heike probably knows a few more than I do, and Marika and Catherine too. But inevitably, it's all a good thing. So maybe we just have a bit of faith. The direction of travel is the most important thing. And maybe we just try and enjoy the journey a little bit. Thank you.
Well, I don't know how Heike's feeling about faith and the Have a Go heroes having brought us to where we are today. So Heike, I know it's 4 a.m. your time, and so forgive me for asking the challenging question, but how adequate has the ecosystem actually been at meeting asset owner needs when it comes to this divergent views and divergent practices?
Thank you, and I've really enjoyed the discussion. It is quite varied. There's different perspectives. I think I do want to go back to some of the things that we were saying earlier, and the focus of this panel is on the S in ESG. Although I do have to always make the point that it's connected. We focus on climate, and climate is the challenge of our generation because of its impact on social, because of its impact on people. Just going back to some of the things that Andrew said, it's all good. This focus, the conversations, this increasing awareness of how environmental, social, and governance risks affect the value of our investments from the investor side and from the issuer side, the awareness that investors care about these issues is all good. It all helps us move in the right direction, or it's the rising tide. All the boats are rising. I said earlier that there's a risk that we focus too much on, and I just mentioned the data, but Andrew also said, don't let perfect be the enemy of good. That's the key message is, have conversations. Investors are creating their own approaches, their own methodologies. We heard that from Marika and from Catherine and from Christian, to become aware, to learn more about what's behind not just labels, but also behind issuers, and use sort of data and checklists as starting points for whatever approach you're going to have. And the green bond principles, social bond principles, and sustainability bond guidelines that ICMA is coordinating these dialogues, these conversations. It's good to create awareness, and the simplicity is hugely valuable. When we issued the first green bond, I think that's what the Swedish investors that worked with us on that product, that's what they were looking for. They were looking for a simple product that traded like other things, that was rated like other products they knew. So we have to just balance sort of simplicity with doing the right thing. Maybe I'll just end there. Pass back. Christian raised his hand.
No, I think it's really interesting, the idea of perfect being the enemy of good. And I think, Catherine, you alluded to this at the start when you spoke of the bushfires and the droughts that there were in Australia. And those things happen and they force action. There is no time to work on perfection. I'd love to hear what some of the lessons and takeaways New South Wales had from the bushfires, perhaps, were, and how what the impact that has been on the way you think about social and community, for example, has been.
Thanks, Tamara. Yeah, as I mentioned at the start, in the last couple of years, New South Wales has had to face a number of different crises. The first one being drought. So 99.9% of the state was declared as being in drought just before we went into bushfires. You can imagine that the state was so dry that once the fires started, it was just really quite an incredible event in terms of the bushfires, and I know that was across the news all over the world. There were a number of fatalities out of that. There were a large number of homes burnt. There were a number of people, quite a large number of people that were in emergency housing at the time for quite an extended period of time. A number of schools that were damaged, so the community infrastructure in rural communities was damaged. a lot of this happened in rural communities at a time when traditionally in Australia around Christmas and New Year, people would normally be gathering with their family and friends, and also with rural communities where often there's a dependency on travel and tourism and so on. So not only did you have that impact on the infrastructure and the lives of people, but you also had that impact from an industry perspective as well. And then you had the infrastructure that was burned. So in terms of people coming into those areas later on, it was really, really challenging. These sort of crises happen very quickly by their very nature. And so we went through, first of all, drought, then the bushfires, where we set up task forces to be able to assist the people in the community, because that's where the impact was being felt largely. And, you know, personally, living in Sydney, you couldn't go outside and see blue sky for weeks and weeks on end. It was grey, it was difficult to breathe, the air quality was really, really bad, and that was not even being close to bushfires, let alone if you had been right next to them. So day to day, we all felt the sort of impacts, and I don't want to, by any stretch of the imagination, minimise what it was like to be living in those areas at the time. The state government mobilised very quickly to be able to put funding into those regions. So we've spent around $4.4 billion to be able to assist the communities. But we also looked to the future, I guess, in terms of how can we be a more resilient state moving forward, and how can we better serve the people of New South Wales. So one of the key leaders during that time was Commissioner Shane Fitzsimmons. And for those of you who may have had a bit of bedtime reading and read our annual report for the Sustainability Bond last year, you would have seen that there was an interview with Commissioner Fitzsimmons at the time, who was instrumental in leading what was a really great response to the bushfires. He is now leading an organisation within the state called Resilience New South Wales. So the agency was set up soon after to be able to deal with coming events. So the learnings from drought, bushfires, floods and COVID-19, we look to be able to coordinate a future response to disasters. So the vision is to enable people to feel confident in preparing and responding to disasters. And so getting back to the social side, looking at what is the impact on people, what is the impact on their mental health, for instance. How do we actually adequately prepare people for this and service the community should that sort of event happen? So I think the response was reasonably rapid, but also looking to the future. How can we be a more resilient state, and how can we best serve the community going forward in that? On the bonds themselves, I know I can't remember which panel member spoke about this, but there are a number of different labels for bonds, whether they be blue, green, COVID, whatever. To my mind, it comes back to that simplicity that I think Andrew touched on, and that is, Heike actually. Keep it simple. Investors want to be able to look at something quite simply and be able to recognise it as a bond. So for our mind, we've kept our bonds as just straight social, sustainable or green bonds, because anything under that remit to help fund some of these activities can be considered in that way. And maybe if I could just touch on one topic earlier that Heike and Andrew also mentioned, the standards that came out under the multilateral institutions in terms of reporting were really great. And what I find in this community of sustainable investors and issuers and governments is that people are really transparent and willing to share their information. So in setting up our program, we learnt from others on this call, we learnt from other institutions who willingly share their information on websites. And I'm sure the investor community is the same. I think that we've all been able to benefit from other people's learning and knowledge, and that transparency that this industry actually enjoys.
I'm going to be picking up on that, I think, right at the end. But before we do that, I wanted to pick up on one other theme that came up. So you spoke a lot about sort of bringing people with you, is how I heard it. And Andrew, you alluded to this in your own opening around public and private partnership. I was curious, Andrew, if you wouldn't mind for just a few minutes, sharing your view on what you think the changing roles might be for public and private, and indeed the individual, if there's an opportunity there.
Sure. Just checking people can hear me. Okay. So when I came into the emerging market space, which was obviously quite, given my youthful appearance, supranationals and MDBs and MFIs allegedly accounted for something like 30% of the capital flows. If you now look at the emerging market space, MFIs, MDBs, and so on, probably account for rounding up around 3% of the capital. So you could argue that the impact isn't anymore around putting money to work. It's not around enabling the flow of capital from what traditionally used to be called from the west to the east, and you could say those flows have reversed. It really now comes down to what I think is influence, and I think Catherine picked this point up, is that the supranational community, in the way that they rightly talk about the considerations that should be factored into investing, the issues around gender, the issues around poverty, the issues around indigenous populations, the issues around resettlement, that those papers, those studies, those researchers become much, much more impactful and influential. And I'll give you a real example. A couple of years ago, there was a joint study done by GPIF, not the smallest pension fund in the world, and the World Bank Group on how do you apply ESG to liquidity books. And if you think about it, that's also one of the great prizes here. It's not just individual investors buying corporate bonds, but liquidity books in banks, financial institutions. That's a huge amount of capital that potentially could be put to work. Now, there was a very, very good study put together about how do you think about ESG in liquidity books? And it's a really tough area. How do you apply ESG to essentially sovereign debt? And there's, you don't have to give this more than 5 minutes of thought to already come up with many of the contentious issues around it. But if you think about that study influences trillions of dollars rather than billions of dollars to invest in a single product or single project. So I think the inevitability of the role that different people have been much more articulate than I have around our space being around influence, around knowledge, around the sharing of information. I think that's hugely important. The point, though, I think that also gets caught up on this, though, is that when does information become data? If you look at any of our websites, there's a colossal amount of alleged information out there, right? Reports, studies, wonderful numerate quotas, lots of graphs, fantastic articulation, but huge amount of what now is just data for people to try and filter through to make a sensible decision. And when it boils down to it, and I think again, Heike and Catherine picked this up, ultimately there is some simplicity around this, right? You want to put your money to work, you want to invest in the right things, you want to get an appropriate risk-reward return, and you essentially want to leave the planet better than you found it. Now, we're all trying to do those things. We all have amazing amounts of information, but I think the challenge increasingly for regulators, for investors, for issuers, is just this colossal amount of now what we're producing is data. Thanks very much.
Thank you, Andrew. I'm very conscious of the time and would like to ask Antti and perhaps Christian, if we have enough time, to share with us what they learned from this conversation today. Antti, could you kick us off?
Yeah, thanks a lot. This has been very interesting discussion today, and I think for social, the market is developing so quickly. It's a very broad kind of topics, and it's also very abstract in a sense. So it's not that easy to understand as green. But I think the same underlying kind of idea here is that the investors, they are driving this market, and they really want to understand where the money is going, whether it's green, whether it's social. So I think that's the theme that is also going to be there in the future. And also from the issuer perspective, we also share the same view. We want to understand, and we want to show to the investors where the money is actually going. And I think where the market is slowly moving is towards understanding the whole balance sheet. So now we have only been concentrating on the social and green itself. But then what's happening actually on the rest side of the business. So in the future, I think the ESG ratings, they will be helping that side as well. And also, I can fully agree with Andrew regarding the comment on regulation and standards. So I guess the market is still developing fast. So we want to wait perhaps a bit before we set too strict guidelines.
Thank you. And Christian, we're not drowned out quite yet. So could I invite you to share what you've learned from this very rich conversation?
Yes, my main takeaway is that we still have a bit of work to do with respect to standard setting. I share Andrew's skepticism vis-a-vis 600-page documents that emanate from Brussels. That said, I think on one hand you can argue that the power of sustainability derives very much from the fact that it's ill-defined, in the same way that the words freedom, justice, love, or beauty are very powerful just because they're not defined. But that shouldn't stop us from setting standards. So, for example, we all would like to get vaccinated, I suppose, but we're not going to put any product in our upper arm. And we would all like to have, we have a desire for well-audited statements when we look at an annual report, but we're not going to buy bonds that do not follow the international accounting standards, right? So there is a case for standard setting. That does not mean that any standard that has been developed in the North should be applied to the countries of the South. I think a lot of the standards, for example, structured finance that has been developed in the Anglo-Saxon world prior to the global financial crisis have rightly found their way into the dustbin of history. That does not apply to German covered bonds, where I would like to note we have not had a single default in 260 years. Yeah. And we have a dual protection against the issuer. We have a claim and against the collateral pool. I think it's a very good structure. Yeah. And finally, I think that we still need some work on the standard settings. I think ICMA has done a wonderful work. That's the way to do. I think we probably need to make that work a bit more participative in the sense of bringing in people who will actually benefit from the proceeds of those issues. And one other takeaway from me is what Marijke said. Right now, the misuse of proceeds does not constitute an event of default. I think that's something that we need to rethink. Yeah, there should be some element of penalty in the covenants of the bonds for the misuse of proceeds.
Thank you so much to Christian and everyone else on this panel. It sounds to me like we've had a lot to get used to get to learn from, to expand on. We're all looking forward, I'm sure, to Marjun's common ground taxonomy with the European Union. And so thank you all very much. Thank you for speaking to us today. And thank you, Adam Cotter, for guiding us into the next panel.
Well, many thanks, Tamara, for that session. The COVID-19 pandemic certainly did bring into sharp focus the need for the two S's, or what I call the two S's, namely social and sustainable. Now we're moving on to the wider embrace of ESG integration, and I'm pleased to introduce our next two speakers from our partners for this conference, Morningstar. Joining us from Hong Kong is Wing Chan, Director of Manager of Research Practice, EMEA and Asia, and joining us from London is Hortense Bioy, Global Director of Sustainability Research. They'll be walking us through the ESG funds landscape, and almost as if we planned, they'll be doing it in such a way that they bridge Asia and Europe. Over to you, Wing.
Thank you, Adam, for the kind introduction. For those of you who are joining from Asia, good afternoon and good morning if you are joining from Europe. So I'm just going to put up some slides. So together, we're looking to, with my colleague Hortense, it is our pleasure to share with you our observations and perspectives on the major developments and trends within the fast evolving ESG fund landscape. So I'll kick off the presentation focusing on the Asian landscape before passing on to Hortense to walk through the European landscape as we move towards the European block. So just to set the scene in terms of where we're at when it comes to the global demand for ESG funds, we believe sustainable investing is a secular trend that is turning mainstream. There are a few drivers underpinning this. Regulations also play a role, but if we look at the the global demand for sustainable funds, which are funds we define as having a sustainable objective and or have a binding ESG criteria for the investment selection. We have seen record flows as of the December of last year. They total $1.65 trillion globally, which is an all-time high. And just to put things in perspective, if we look at only 12 months ago in December 19, the total assets were only $960 billion. So we have seen a dramatic increase despite the impact of a pandemic throughout much of last year. If we break it down a geographic region, Europe, as you can see, is by far the largest market. There were more than 3,000 funds and over $1.3 trillion of assets. It is important to note that this large group includes UCITS cross-border funds. So the number also include investment, not just from European investors, but also investors here in Asia, especially from the open fund markets such as Hong Kong, Singapore, Taiwan, etc. At the same time, we're also seeing strong growth within the local domicile funds in Asia. They grew from just over $20 billion about 12 months ago to more than $43 billion, as you can see on the chart. So they're really just scratching the surface here as well with that number, because the majority of ESG funds today mainly focus on equities, whereas ESG funds that invest in fixed income and multi-asset are still in its relative infancy. Given this, we expect continued product launches, especially in fixed income and multi-assets, and a growing investor adoption are likely to keep ESG fund assets growing in the foreseeable future. If we try to look at how investors have shifted their equity fund allocations last year, we saw a distinct shift from traditional strategies to thematic strategies, of which ESG is the most dominant theme of all. If we look at the traditional equity funds, especially those that invest into the major regional asset classes such as Europe, US, Japan, they saw notable outflows in 2020, as you can see from the orange bars. In contrast, in the other areas, other than the obvious beneficiaries of COVID-19, such as healthcare sector equity, technology sector equity, the thematic strategies attracted the most amount of assets. And if you look at the top funds within those categories, then they mostly reside in global equity large cap and global equity mid-small cap. Actually, 7 out of the top 10 funds that attracted the most inflow, they were thematic funds, and 8 out of the top 10 small mid-cap funds were ESG strategies. Earlier, we briefly touched on the massive growth of ESG fund assets within the domestic domicile funds in Asia. And here I would like to expand on that a little bit more by breaking down into the different countries and markets. So you can see the Asia ex-Japan markets on the left and the Japanese market on the right. So the key message here is we're seeing diverse contributions from different fund markets, indicating that there is a broad-based growth and it isn't just driven by a specific investor cohort. New fund launches in Taiwan, for instance, jumped from 2 in 2019 to 11 in 2020. Generating $1.7 billion in new inflows. In India, 5 new fund launches in 2020 managed to attract $760 million in new inflows. Over in Japan, the right-hand side, you will have seen a meaningful spike in the third quarter of last year. It was primarily driven by the launch of a single fund, the AM1 Global ESG High Quality Growth Equity Fund, which itself attracted $5.5 billion alone. In addition to the growing investor demand, regulations is also an important driver underpinning the shift towards ESG investing. Europe is leading the charge with the EU Sustainable Finance Action Plan, which aims to reorient capital flows towards sustainable investments. And I'll let my colleague Hotan speak on that a little bit more. But here in Asia, regulators are keen to make sure that funds are accurately represented. They're also keen to make sure there's minimal risk of greenwashing as well. For example, in Hong Kong, the Security and Futures Commission, the SFC, has published practical guidelines in April 2019, requiring funds that promote ESG-related mandates be named accordingly and invest at least 70% of the assets in security that meet at least one of the globally recognized ESG principles disclosed in the offering document and investment objectives. Later in the year, the regulator also launched a website, which is the screenshot that you can see here, showing the funds satisfying those requirements. and the list has been periodically updated to account for the new fund launches that we've been seeing over the past year or so. So just to summarize, we believe the growing investor demand, continued product launches, and regulatory changes are driving investors' shift towards sustainable investing. And at this point, I'd like to pass on to my colleague Hortense to share with you the fund landscape in Europe.
Thank you very much. Thank you very much, Wing. So if you move to the next slide, I think I'd like to start by stating the obvious. 2020 was a year like no other. It will obviously be remembered as the year of the coronavirus pandemic, which rapidly spread across the world, killing people and disrupting everyone's day-to-day lives, while highlighting deep global inequalities. But simmering in the background, 2020 was also the year sustainable investing reached a pivotal point. Spurred by the COVID-19 crisis, many public companies, asset managers, and governments stepped up the commitment to sustainability in the last year. More asset managers than ever are now incorporating ESG factors into their investment processes and purposefully engaging with companies on material issues ranging from climate change to employee treatment, supply chain oversight, and diversity and inclusion. Meanwhile, as Wing showed you, demand for ESG-focused strategies reached a new height. 2020 was a year of broken record in terms of flows, assets, and product development. And it was particularly an exceptional year for European ESG funds, which, as you can see on these two charts, smashed through the 1 trillion euro milestone in terms of assets. So up 52% relative to 2019. And you can see also that, now you can't see that on the chart, but actually this 52% growth compares with a mere 3% increase in assets for the entire European fund universe. And also what you can see here is that the asset growth has accelerated really in the past couple of years, especially in the past few quarters. The ESG fund assets registered the highest growth in the fourth quarter of last year, supported by significant inflows. Next slide, please. Last year, European ESG funds attracted record high inflows of 230 billion euros. This was almost double the flows in 2019 and 10 times higher than just 5 years ago. And flows in ESG funds were particularly high in the fourth quarter again. They reached a record high of 100 billion euros, which represents 45% of the flows in the overall fund universe. So in other words, in Q4, ESG funds took almost half of total European fund flows. Now, there are several factors that can explain these high inflows. The prospect of more regulation in the space is one, of course, but there is also a realization by investors that ESG funds offer comparable or even in some cases better performance than conventional funds. And I think the COVID-19 market crisis was a good test in this respect. COVID-19 has also accelerated investors' interest in sustainability issues. And that's actually perhaps one of the few silver linings of the pandemic. It has forced many people and companies to think about sustainability issues and climate change in particular. Next slide, please. And this is evident here. When you look at the flows into climate-themed funds, here you can see that investors poured 27 billion euros of new money into those type of funds only in the fourth quarter of last year. You see this massive peak in Q4. Climate funds were also among the best-selling funds in the last quarter. 7 funds had an environmental flavor. So 7 funds out of the top 10 best selling funds in terms of flows in the fourth quarter had an environmental flavor, and 6 among them attracted more than €1 billion in inflows each. Clean energy funds were very popular, particularly explained by the good performance in the past couple of years. Clean energy funds were certainly the big winners of 2020 in terms of performance. Some of them achieved more than 200% returns. I'm not going to go into the detail of the different types of climate funds, but you can see at the bottom right-hand side of the screen that there is really a variety of approaches which go from simply decarbonizing a portfolio, so that's kind of the light green approach, to investing in climate solutions, green bonds, and clean technology, which is the dark green approach. Next slide, please. Now, when you look at product development in 2020, I think it's fair to say that the European sustainable fund space saw an unprecedented level of activity on that front, with 505 new ESG fund launches in 2020. Asset managers continue to expand the range of options available to investors in terms of asset class, market exposure, and theme. Equity remained the source of the greatest product proliferation, though, followed by allocation and fixed income. And we saw an acceleration of new products in the passive space as well, in ETFs in particular. Passive ESG offerings represented 19% of total new launches last year, up from 14% the year before. And these included some interesting Paris-aligned type of strategies in both equity and fixed income. And in 2020, while broad ESG funds continue to represent the bulk of new offerings, funds with an environmental flavor accounted for close to 14% of new launches. In addition, last year we saw some other thematic funds being launched targeting themes like smart city, for example, the ocean, gender diversity and inclusion, and also the broad UN Sustainable Development Goals. Next slide, please. Now, launching new funds is not the only way asset managers respond to increased investor demand for sustainable investment options. They also repurpose existing conventional funds by changing the investment objective of the funds or by adding binding ESG criteria to their investment policies or by adding ESG exclusions. And many reflect the new mandates by rebranding the funds. So consistent with what I've told you so far, the number of repurposed funds hit new highs last year, 253. It's the dark green bar that you can see on the chart. And repurposed funds now represent more than 20% of the 3,196 ESG funds that we have identified as available to European investors. Transforming existing funds into sustainable strategies is a way for asset managers to leverage existing assets to build their sustainable fund business. They have, so they don't have to create funds from scratch. This may also be a way for fund companies to reinvigorate funds that are struggling to attract new flows. Next slide, please. Now, it's fair to say that the European ESG fund market is becoming increasingly competitive now. These are the asset management firms that benefited the most from the higher investor demand for ESG funds last year. And in Q4 alone, BlackRock garnered more than 15 billion euros of new money, boosted by its ETF business. As I said, as the European ESG fund market grows, it's becoming more and more competitive, with asset management firms wanting to attract new flows in the space and be recognized for their ESG credentials. Next slide, please. And this is why we've introduced a new metrics, because we've recognized that it is increasingly difficult for investors to understand the differences between the manager's ESG capabilities and offerings. So as you know, there is a lot of confusion out there. It's become harder for investors to separate asset managers and funds that truly focus on sustainable investing from those that incorporate ESG factors in a more limited way. So this is why Morningstar last November launched this new metric called the Morningstar ESG commitment level for asset managers and strategies. And what this new metric does is that it expresses our analysts' assessment of the extent to which ESG factors are incorporated into the asset management firms and strategies that we have under coverage. And the commitment level, the ESG commitment level, complements other ratings that we make available to investors to help them make better informed decisions. Next slide. So here I'm just showing you our assessment of the first round of asset managers that we evaluated. And so as you can see, you know, our commitment level goes from low to leader. So it's a 4-point scale. And really, I think in the leader category, you may not be surprised to see some of those names here. These are firms that have been doing ESG for a very long time. I think it's fair to say that ESG is really part of the DNA of those firms. These are firms that have top-notch resources, that really have ESG ingrained into all aspects of what the portfolio managers do. And also they're very active owners through voting and engagement. So I'm not going to spend too much time on that. I just wanted to introduce this, to present this new measure. But if you go to the next slide, I'd like to talk a little bit more about a specific type of product. I talked about climate funds, but now I'd like to shift the focus to the social theme. Because as we know, the COVID-19 crisis has really brought social to the forefront of ESG investing. Fund managers are paying more attention now to social considerations such as labor rights and diversity. But also at the same time, you know, as we know, investors are also looking to invest to make a more positive impact on society using primarily the UN Sustainable Development Goals as a guide. And this is really reflected in the flows and assets into these funds. Again, in 2020, flows into socially themed funds and broad impact funds have more than doubled, while assets have increased by almost 50%. And the biggest single social theme last year was diversity and inclusion. Next slide, please. This is also what we're seeing when looking at new fund launches. After broad impact funds, which is represented by the blue bar, so broad impact funds really target a range of themes. So these remain really dominant. But if we drill down into single social theme, again, as I said, diversity and inclusion funds were the most the second most popular. The second most popular category. So diversity and inclusion was a very popular theme in terms of product development last year. Also, last year, out of the 16 new funds that focus on the specific social theme, 5, we also saw some social bond funds. As we know, this is a something we're going to see more going forward. But you can see here at the bottom really those more the dominant launches last year, which again were more diversity and inclusion funds. Next, and I think this is my last slide. Finally, I'd like to finish with this slide on regulation, because in Europe, I mean, I think you can't really talk about sustainable investing without mentioning the role of regulation. This year will be another big year for ESG funds, particularly in Europe with SFDR, the Sustainable Finance Disclosure Regulations, which kicks in actually next week from the 10th of March. Through enhanced ESG risk and impact disclosure and other measures, the regulator really aims to encourage the flows of capital into sustainable activities to meet its goal of a net zero economy by 2050. So we're going to see more money flowing into ESG funds, and I think it's going to be interesting for us to know how asset managers classify the funds, whether which ones are going to be Article 8 and Article 9. I think at this point there is still not completely clear how the landscape is going to look like with this new classification. But we will of course align to this new classification to be in the spirit of the to align with the spirit of the regulation. And this is something that we will also reflect in our database. We're going to start collecting all the data that will become mandatory for asset managers to disclose starting from now. So I'm really looking forward to presenting perhaps a different landscape next time we look into this with this new classification of Article 8 and Article 9. With that, I'm going to turn it back to Wing.
Hello, Wing, you're on mute, but I believe that wraps up the presentation. So many thanks, Hortense and Wing. It seems that with more ESG funds out there than ever before, I'm sure Morningstar analysts will be kept busy allaying all the investors' concerns about different funds' approaches to integrating ESG. So many thanks for giving us more depth on that. Well, this wraps up the so-called Asia segment of today's global conference. And with that, I'd like to once again thank all our speakers for their time, and of course all the attendees for joining us so far. I hope our European friends have now had time to finish their second breakfast, and I will pass on to Dr. Nader Maleki and Frank Scheidig in Frankfurt to continue with the program. Thank you.